Okay, good morning everyone. Right, so we will start our discussion for today. So in the previous session, we have completed professional ethics. So all the concepts we have covered, various schedules we have covered, the rules and regulations regarding membership, practice, what you are supposed to do, what you aren't supposed to do, and even general council guidelines and even recommendatory measures, recommendatory self-regulatory measures. So all that things we have covered. Even with the questions we have covered it. So this chapter, the previous chapter which we have completed, that is the professional ethics chapter which we are done with, that is actually an advantage for the students. This professional ethics, it will definitely be an advantage having this chapter as a part of this particular subject. Why? Because easy to remember, no complication, no complexity of the questions will be there. No matter whatever ways they try to twist the question, they have to ask us, they have to ask it from the schedules only, hard and fast rules only, right? So if we could put some minimum effort with all the things whatever I have told you in the class to remember, and if you could put minimum efforts also, with that minimum efforts you can score a very good amount of marks from this particular chapter. If your time is so good enough, if you are so lucky enough, there were a previous few attempts where they have tested even somewhere around 15 to 18 marks they have tested from this single chapter alone. If you're so lucky enough, but these days we are not getting that lucky. But whatever it is, somewhere around 10 to 12 marks you can expect it from this chapter. In the worst case scenario also 10 to 12 marks you can expect from it. And previously what used to be the testing pattern is they used to concentrate more on schedules, like we have seen first schedule, second schedule. The questions used to come from there. So minimum 2-3 questions used to come from there. Main focus used to be on schedules, but these days what they are doing is they are slowly deviating from the schedules. So they're only asking just one question or so, like in the schedules. The remaining questions are asking from membership related, disabilities, especially branch office related things, and here and there in MCQs, council guidelines. So they have even expanded their testing. So previously main focus used to be schedules. Even we used to concentrate more on schedules, and we used to concentrate less on that introductory information, code of ethics part and council guidelines. We used to ignore it, but that is not the case now. See, the pattern, the exam has become in such a manner that if you have to take a choice, you have to take a choice of the entire chapter. Previously what we used to do is what the strategy used to be. So we used to select a few questions from the chapter, few concepts we will read, few concepts we used to take it as a choice, but that is not actually working today. If you have to take a choice, take certain chapters as choice altogether. But if you have decided to prepare for a chapter, you have to read each and everything from the chapter, mainly because of these MCQs. We don't know from where the question will come. So you read one important concept, you leave some other concepts, then might be whatever concepts you have left out from the chapter, from that a question could be tested. Then your choice decision making is completely wrong there. So if at all, in extreme cases, if at all you are unable to cover the entire content, if at all time is not available for you to cover the 100% of the content, if you have faced such a situation where you have to take a choice, I would say take some chapters as a choice. Take certain chapters as a choice. Don't be choosy within the chapter. I will prepare for this content in the chapter, rest of the content I will leave it as a choice. No, the things have changed a lot. So whatever we feel important from that question is not coming. So whatever we ignore, whatever we feel complex, whatever we thought, okay, this is not, I'm not able to understand, I will leave this part. From there the questions are getting tested, especially MCQs. From that minute details only the questions are getting tested. So my request will be, if at all you have decided to take a choice, I will tell you chapters, but not now. Now I will not tell you. So I will, if I tell you now, I have to teach the class to be benches in the walls for that chapters, for that particular chapter. So I don't want that to happen. So I will tell you at the end when the sessions are about to complete. I will tell you which chapters altogether you can take it as a choice. But please make sure that if you have picked one chapter for preparation, you are reading each and everything, every nook and corner, everything, every sentence, every word, every line, every question from the question bank. You are doing it. Make sure that happens. So that is a strategy only which is available today in order to qualify in the examinations, right? So having said that, having successfully covered the biggest chapter we have, which is professional ethics, now we are left with few more chapters. So now what we will do is we'll try to talk about some apart from the traditional standards, we'll try to do some practical things. Like for example, next the 3 series of chapters which I will try to pick up is, one is audit of banks. Audit of banks we'll try to complete first. Then we will do audit of NBFCs we will try to do. Then after that audit of PSUs we will try to do. So these 3 chapters will be our next immediate target. Now from these three chapters put together, what is the weightage which you can expect is worst case scenario 8 marks, and if your time is good enough, it could fetch easily somewhere around 12 to 15 marks here also. If in the worst case scenario also, if you prepare for these three chapters, 8 marks you will secure it somehow. If your time is good enough, from these three chapters you can get somewhere around some 12 to 14 marks also you can get it from this chapter. So somewhere the range happens between 8 to 12. And I generally treat this as a cluster. I don't treat it as some standalone chapters and all. I actually treat it as a cluster. So this cluster we will take it in all in one go. Okay. So till now we have understood whatever discussion we had till now. So that is mainly revolving around standards, like whatever we have understood from day one itself. We understood the introduction to audit. We understood what do you mean by audit evidence, how to do the audit reporting, what are the different methods to obtain audit evidence. So risk assessment, internal control, strategy, planning and program. So in all that chapters, the subject matter of our discussion has been the standards on audit which are issued by ICAI. And when it comes to professional ethics, the chapter which we have just now completed, that professional ethics chapter, what is the source I have told you from where this professional ethics chapter has been taken from? So it has been taken from the Code of Ethics, Chartered Accountants Act 1949, and the regulations given by Council and also guidelines given by Council. So this is the source for the chapter professional ethics. Now when it comes to the three upcoming chapters which we are about to discuss, number one, audit of banks, audit of NBFCs and audit of PSU, this I can say engagement specific chapters. These three are what? Engagement specific chapters. That means these chapters will tell you if you are doing audit of certain business, how you have to do that audit. And all these audits are, instead of being governed by the standards on audit, we have some extra rules and regulations. Like if you remember when we are discussing the professional ethics, I have told you that generally accepted audit procedures. Generally accepted procedure of audit. So there I told you that generally what is a generally accepted audit procedure, that depends on the facts and circumstances. Now in rest of all engagements, generally accepted audit procedures will be determined by standards. In normal audits, if we are doing audit of any company, our scope of audit, our rights, our responsibilities, our reporting, the manner of obtaining evidence. So their generally accepted audit procedure will be determined by the standards. But when we come to these entities like banks, NBFCs and PSUs, here also our generally accepted audit procedures to some extent depend on standards on audit. Apart from that, here what is a generally accepted audit procedure also depends on the governing statutes of these respective organizations. So there are some governing statutes for these three kinds of organizations like banks, NBFCs and PSUs. There are governing statutes. Like if you take for example banks, we have the governing statutes for the bank are Banking Regulation Act, RBI rules and regulations will be there, and circulars given by the RBI will be there. So if we are conducting an audit of bank, what audit procedures we have to perform, how we are supposed to do the audit, that will be governed by the standards on audit. In addition to that, we also need to pay attention to the Banking Regulation Act and RBI rules and regulations. The same thing happens with the NBFC. If you are doing audit of NBFC, what will be a generally accepted audit procedure there, that will be governed by the standards on audit. In addition to that, it will also be governed by the RBI Act, Banking Regulation Act, rules and regulations, NBFC guidelines. So that will decide it. If we are conducting audit of PSU, in that case also, what will be a generally accepted audit procedure will be determined by our standards, and also we have to follow the provisions of C&AG guidelines. C&AG guidelines and all will be there, so that we need to follow. So these are three such special areas where we do audit, we comply with the standards, at the same time we also must comply with the guidelines, or we also must comply with the governing statutes under which these entities are created. Okay, so that's what we are going to discuss now. First we will start with, in this cluster we will try to start audit of banks today. We will also try to complete the audit of banks today. So today this chapter will start and we will end this chapter in the same session. Today we'll try to do it. And as a part of this chapter, our discussion is mainly taken from the Banking Regulation Act. It is also taken from RBI guidelines. So mainly our discussion will be revolving around this. Okay, right. So mainly as the chapter itself says, this chapter is going to talk about, in case if we are getting appointed as an auditor of a bank or a banking company, so how we are supposed to do the audit, what points we are required to check, what procedures we have to follow, so and what reporting requirements we have. So it will be quite different from the regular audit. So when it comes to acceptance of engagements, the things are going to be little different. When it comes to planning, the things are going to be little different. When it comes to execution, the things are going to be little different. And when it comes to reporting, then also things are going to be a little bit different here. So what we are supposed to do before we can accept, or when we can accept audit of the banks, when we cannot accept audit of the banks. So how we are supposed to do the planning of the audit of the banks, how we are supposed to execute the audit of the banks, and how we are supposed to do the reporting of the banks, everything we are going to cover in this chapter. Okay. So but before we go into that audit related matters, can somebody define me what is the meaning of the bank when we call an organization as a bank? When we call an organization as a bank, we call an organization as a bank if it is engaged in two activities. It must be engaged in two activities. What should be that two activities it must be engaged in? Number one is it should be accepting deposits. Number two, it should be giving loans. When an organization is conducting both of these activities, then we call such organization as banks. And as we all are aware, banks play a very crucial role, not just in the business terms. Banks play a very crucial role in making or breaking the economy. They play a very crucial role in either making the economy, or it play a very crucial role in even breaking the economy. So those countries or those economies which have properly managed their banking sector, they have made their economy so stronger that they are almost ruling the world. Like for example, if you take this US and all, so American banking system is so good that they are ruling the world because they are very strong in their financial sector. Whereas some economies are there which have not utilized that scale of the banking operations, and they are still developing and they will remain developing, and there are some underdeveloped countries also. So banking sector is such an important sector which is very crucial for the financial economy of the country. And we have something called financial sector. We say something called financial sector of our country. So whenever I say financial sector of the country, two entities will get covered here broadly. Banks also will get covered in the financial sector. NBFCs also will get covered in the financial sector. Now, what is the differentiation between a bank and an NBFC? How do you differentiate between bank and NBFC? So when it comes to bank, as I have told, bank will perform two activities. It will accept deposits and it will also give loans. Whereas when it comes to NBFC, it will do only one aspect. It will do only one accept. Either they will accept the deposits or they will give loans. So majority of the NBFCs in India are doing the second activity. Mainly they are engaged in the giving of the loans and all. Like if you take Bajaj Finance, DHFL. So like that we have so many organizations which are doing only one aspect of this activity. So that we broadly call them as NBFCs. Now, see, let us see what role does banks play in any country. What are the special features of the bank? What are the features of the bank? How the banks differ from other kinds of organizations? How do banks differ from other kind of organizations? Number one, they deal with the public money. They deal with the public money. Normal organizations might not be dealing with the public money. If you take the so-called listed companies like Reliance, Infosys, all these companies you take, these are nowhere dealing with the public money. They are doing the business, they are generating the revenue, they are spending it, they are having their own assets. But banking business is such a business where banks are not dealing with their own money. Banks are dealing with the customers' money. The banks are dealing with the common public money, like you and me. The banks are dealing with our money. So that's why the banks enjoy something called reputational risk. What do banks enjoy? Not banks enjoy, banks face, sorry. So risk is not enjoyable. So banks face something called reputational risk. What do you mean by reputational risk? Just imagine if a small bad news comes regarding any bank, what is the chaos it is going to create? So just say for example, you are an account holder of some bank. You have money in your bank account. You wanted to transfer that money. You started trying to do UPI. UPI transactions are not happening. You are in urgent need of cash. Now UPI transactions are not happening. Now, but you have an ATM card. You urgently need the cash. You went to the ATM. ATM is not working. Then you went to the branch to withdraw, to write the slip, to give your account details and withdraw the money. Branch is telling, no, we don't have any funds today. We don't have any funds today. Just if the bank says that to one customer, just imagine what is the crisis which is going to happen. Within a few hours, there will be a crowd standing in front of the branch and with the stones in their hand pelting at the windows of the bank. So this is what this risk we call it as reputational risk. Even if a small bad news goes in the public domain regarding the bank, it will have entire effect on its operations. So they deal with the public money and they face something called reputational risk. And one more major feature in the today's environment, one of the most important feature of the banking sector is they are completely computerized. What has happened to them? They are completely computerized. The bankers are the biggest users of the technology in the world. They are the largest users of the technology. So traditionally, the transactions used to happen manually. Today, people have even stopped visiting the branches. What is the last time when you have visited the bank? According to me, if I have to make a decision, I might have visited somewhere around 3 or 4 years back. In this 3 or 4 years back, I have not even visited a bank. The same thing might have happened with you also. So the banks have adopted technology to such an extent that even people have stopped going to the branches. And thanks to these UPI transactions. So because of this increased acceptance of these UPI transactions, we are not even carrying the cash in our pockets also. So wherever we go, even if you want to spend a 10 rupees also, you need not carry any cash in your pocket. You can make the payment through your UPI payments. So are the biggest users of the technology. Number three, what is one more characteristic of the banks is they have wider geographical spread. What they have? Wider geographical spread. So what do you mean by wider geographical spread? The bank is having the biggest network. Do you agree with me? So you go to remote areas of the world, you go to remote areas, especially in India also, even if you go to the remote rural areas of the India, still you will be able to find some branch there. Some SBI branch you will always be able to find it. And these banks in India, and even if you take the global banks, they don't have their branches only in India. They are even having their branches outside of India. So banks have very much wider geographical spread. What are other features? These are all regulated. Banks are all regulated. Do you agree with me? Who is the regulator for the banks? RBI. So RBI, which we call it as central bank. So RBI is the regulator of the entire financial sector. When I say financial sector, as I have told, two kinds of organizations will come. Banks will come, NBFCs will come. So both banks and NBFCs are getting regulated by the central bank called Reserve Bank of India. Now, how does this Reserve Bank regulate this banking sector? What actions RBI will take to regulate the banking sector? Number one, first thing, they will decide something called CRR SLR ratio. To maintain the liquidity of the banks, they determine something called CRR SLR ratio, which banks are required to mandatorily comply with it. And by increasing or decreasing that reserve ratios, they maintain the economy, they maintain the cash supply and demand, they will try to maintain it. And if at all you want to carry out any banking business in India, or any existing bank even wants to open a new branch in India, they can't do it unless they get the permission from the RBI. You can't even open a new bank or NBFC, or even an existing bank or NBFC can't even open a branch also unless we get the license from RBI. So RBI is a licensing authority without whose registration certificate we can't carry out any banking business in India, or even we can't carry out NBFC business in India. And also a few more mechanism, RBI will also have a power to investigate any bank, any branch even without a prior intimation also. What power will be there for RBI? It is having the power to verify and inspect any bank, any branch, even without any prior intimation, they can go and verify it. Clear, everyone? So like that, there are a few features of the bank. These are not just the features, we will read later what all are the special features of the bank. So these are all few features of the bank, very few out of many, which distinguishes the banks from other kinds of industry. And do you think audit of banks is more important than other entities, or other entities audit is more important? Audit of banks is very, very important. Why? Because banks are playing with the trust of the common public, and as I've told, they enjoy something called a reputational risk. And also there is a huge scope for manipulation because the bank is dealing with huge amounts of money. So a very bulk amount of money they are all dealing with. So huge scope of manipulation. So that's why then when compared with other organizations, audit of banks is very, very important, and it is very, very prominent. And you tell me where the audit mechanism is more robust. more stringent audit where we will do? Will we do it in other entities or will we do more stringent audit in banks? We are supposed to do more stringent audit in banks. Where do you think our reporting requirements are more? In other entities reporting requirements are more, or under Banking Regulation Act reporting requirements are more? Under the bank's reporting requirements are more. So we will see in the chapter the list of reports which auditors are required to send it. So if you are conducting audit of a normal company, you will give an audit report as per SA 700 series. If at all it is a company, you will comply with the requirements of 143.1, 141.3, 143.3, 143.11, 143.12. These are the maximum reporting requirements which you will have. But when it comes to auditors, when it comes to audit of banks, there are various plenty of reports which you are required to give. So number one, you will give main audit report as per SA 700 series. Along with that, in the case of nationalized bank or any other public PSU banks, you will be required to send one separate report to the central government. And in some cases, you are required, and majority of the cases, you are required to give something called LFAR, long form audit report, something like that will be there if you have done the bank audits and all. LFAR reports you are required to give. And RBI has also suggested a list of reports like report on deposits, report on internal controls, report on the recommendation implementations of various committees. So like that, a very lengthy list of reports have been prescribed by the RBI. Even all that reports also you are required to give. So we are going to read all that reporting requirements also. And most important thing is, if you are conducting an audit of bank, or if you are conducting another entity. See, generally in other entities also, if I am conducting audit of Reliance, am I required to be concerned about the technology being used in Reliance? If I am conducting audit of an entity like Reliance Industries Limited, so as a part of my audit, is there any requirement on me to even pay attention to the technology, software, whatever the entity is using? Yes. Why? Because today even accounting, finance related matters are driven by technology. So definitely in normal entities, I will be concerned with the technology. I have to pay attention to what kind of accounting softwares they are using, what kind of internal controls they are having, how the financial data is getting prepared, how accounting entries are getting recorded, what kind of internal controls they have implemented. This I will generally verify in the case of normal entities audit. Do you think is that required even in the bank audit also? The study of the technology, what they are using, what softwares they are using, are you required to check even that in the banks also? Yes. In a more in-depth manner or lesser than the other entities? In a more in-depth manner. Why? Because banks use something called core banking solutions, CBS softwares they will use, where each and everything is automated. Each and everything is automated. And even if you look at this core banking software solutions, they are so developed that if you have an account today, you sit here, do a UPI transaction from your mobile phone, from your network, the data has to be captured by the bank, and on a real-time basis, your balance should be updated. You are doing using your mobile without any direct connection to the bank server, you have done a transaction. Now immediately this transaction should be reflected in your bank account which is maintained with the bank. Yes or no? So just understand the level of integration, the level of technology they are using. So if something goes wrong in the core banking solution, even if a small little bit of manipulation has happened, little coding error has taken place in the core banking solution, that could result in millions and billions of frauds and errors. So that's why we must be very much concerned about technology. We need to take some extra efforts regarding the client's automated environment. We need to study some extra aspects. We need to study some new things. We need to study some extra things regarding the client's core banking solution. So we will talk about that, what things you are expected to do regarding the technology of the audit of the banks. That also we will try to have a look at it. Okay. Then talking about the next part. So could you tell me what and all are different items of the financial statements of the bank? What and all will be major items of the financial statements of the bank? That we'll try to have an overlook once. So if you take financial statements of bank, how the financial statements of the bank will be prepared? As per Schedule 3 and Ind AS? No. Financial statements of the bank will be prepared as per Banking Regulation Act. So we'll prepare it as per Banking Regulation Act. Do you think Ind AS is applicable for banks? No, currently Ind AS has been deferred. In the near future, they might implement it, but currently for the scheduled commercial banks, Ind AS applicability has been deferred. They might become applicable in the future. That effective date is yet to be notified. Currently, all these banks are all following accounting standards only. Normal accounting standards they will follow. Ind AS has been deferred for the banks. So whatever it is, every bank will have their books of accounts. Every banks will prepare their financial statements. Now, could you tell me, first we will talk about the balance sheet. What are the main items of the balance sheet of the bank? Let us talk about assets first. Let us go with the positive first. So assets, what can be coming under assets? So first, let us come in the order. Non-current assets will go in that order. So first, what will be there? Fixed assets will be there. Fixed assets and premises will be there. So the company will have, the bank will have buildings for running their business. They might have this machinery, they might have this electrical fittings and all. So they will all come under fixed assets. Apart from that, what else will be there? Loans and advances will be there. As I have told, one of the major asset of the company is loans and advances. The main business of the bank is giving the loans and all. So they will give short-term loans, long-term loans, secured loans, unsecured loans. So multiple kinds of loans they are going to give. So loans and advances will be the next important part of the balance sheet. What else will be there apart from that? Bonds and all. Okay, investments broadly. Financial instruments, we can say investments. The bank will deposit the money with the RBI. So that we call it as bank balances. So let us say one more head, bank balances will be there. When I say investments, banks will invest in the shares of other entities. Banks will invest in the bonds, debentures, even they will invest in the gold, highly liquid assets, CRR, SLR ratio requirements. So they will all make their investments. And also they will have bank balances. Balances with RBI. They will have to maintain certain amount of balance with RBI. They have sometimes they have they have balances with other banks. Sometimes they have balances with the foreign banks. So whatever it is, bank balances will be there, and they also have huge amount of cash, and they have huge amount of cash also will be there. So apart from that, some other kind of assets also will be there. So there will be something called inter-branch adjustments. Those kind of things will be there. Interest accrued on that loans and advances, that will be there. So there will be plenty of things like that. Now when you come to the liability side, what will be there under liability side? What will be there under liability side? Under liability side, first you will have capital. First you will have something called capital. And when it comes to banks, there is something called capital adequacy ratios. There will be something called what? Capital adequacy ratio. That means RBI has told, depending upon the risk weighted assets. I will talk about it in a detailed manner when we go to the capital verification. So RBI has told you have to maintain certain amount of capital depending on the risk weighted assets you hold. So something in that format they say. So we have something called capital adequacy ratio. Banks are all supposed to maintain minimum capital adequacy ratios they have to maintain. So that capitals they will have. Apart from that, they will also have reserves. What will be there under reserves? Capital reserves will be there. Revenue reserves will be there. Accumulated profits will be there. If it is a company which has issued the shares, a securities premium also could be there. So like that, various kinds of statutory, non-statutory, voluntary, compulsory, all the reserves also will be there. Then apart from that, what will be there? Banks also will have borrowings. From whom banks will borrow? Banks will borrow from RBI. From the RBI they will borrow. From other banks they will borrow. From foreign institutions they will borrow. So from financial institutions they will borrow. So all the borrowings also will be there here. Apart from that, deposits. Deposits from the customers, which we broadly call them as DTL. What is DTL? Demand and time liabilities we call them. What do we call them? Demand and time liabilities. So what will come under demand liabilities? Demand liabilities means what? Those which are payable and demand, I know it, but what will come under demand liabilities? Current accounts and savings accounts, they will come under demand liabilities. What will come under time liabilities? Fixed deposits, recurring deposits, these all will come under time liabilities. So demand and time liabilities will be there. Apart from that, they will also have something called provisions. Provisions also will be there, no? Banks are required to create provision. So provision for bad and doubtful debts, provision for NPAs, and even they need to create provision for taxes, provision for expenses. So even all that provisions also will be there. So these will be the major items of this will be the major items of the assets and liabilities. Now we are going to see in this chapter what things you need to verify, what documents we need to verify, what evidence we need to obtain, what items regarding which we need to obtain evidence regarding each and every item. We are going to see how to verify fixed assets, how to verify loans and advances, how to verify investments, how to verify bank balances, how to verify cash, how to verify capital and reserves, how to verify and borrowings, how to verify deposits, how to verify provisions. All we are going to see. Apart from that, banks also will have significant amount of contingent liabilities. What will be there? Banks also will have huge amount of contingent liabilities. Sir, what kind of transactions will give rise to contingent liabilities? What kind of transactions? I told definitely banks will have huge amount of contingent liabilities. But which kind of transactions will give rise to that huge contingent liabilities? There will be something called non-funded advances. Whatever loans and advances which are given by the bank. I'm talking about the loans given by the bank. So loans given by the bank can be broadly divided into two categories. What are the two categories? Well, number one is funded advances and the other one is non-funded advances. Funded advances are those advances which are involving outflow of funds from the bank. If the bank has given any loan or advance which involves outflow of funds, that means the bank will give you money in those kind of loans and advances. Can you give me a few examples there? Housing loan, you take simple, all the loans which we know. Housing loan, if your bank has given housing loan, will they give you money or not? Yes. If you have taken a working capital loan like OD loan or cash credit, will the bank give you money or not? If you have taken a term loan, will the bank give you money or not? Yes. In some cases, bank will give loans, but which does not involve any outflow of funds. So what are they? That means immediately they will not release the funds, but they will give a commitment. Like for example, letter of credits, bank guarantees. These are not immediate liabilities. The bank will act as a guarantor on behalf of their customers. If the customer doesn't honor the payment, then the liability will fall on the banker. So mainly these non-funded advances are the major items which will contribute to contingent liabilities which are reflected in my financial statements. And these have become very risky kind of investments. These have become very risky transactions after that PNB scam has came into light. So this PNB scam is completely revolving around this bank guarantees and letter of credits only. So they are able to pull off that 11,400 crores worth of scam completely using that non-funded advances. So after that scam, entire things have changed. They have started bringing new regulations. They have identified a very weaknesses in the core banking solutions which they were not aware previously. So many deficiencies were identified, many rectification actions were taken. Actually, it has changed the RBI's perspective regarding this letter of credits and bank guarantees. These many frauds could happen. Even RBI realized it because of that PNB scam. So whatever it is, the contingent liabilities mainly arise out of non-funded advances whatever bank has given as a part of the regular business. So we have seen balance sheet items. Now let us talk about P&L items. What will be there in the P&L items? What will be there in the P&L? Starting with the revenue. What will be the major revenue of any bank? Tell me. Major revenue of any bank. The main income is interest income. So they give loans, they give advances, not for free of cost. They are going to collect interest from you. So that could be a normal interest from loans and advances. That could also be sometimes bill discounting. So sometimes banks will do bill discounting. That is also in the nature of interest income only. That also will come under interest income only. And what are other kinds of income? Sometimes banks hold properties. As a part of settlement, they get the properties. They have to dispose it. But in the meantime, what they can do is they can rent out that properties. From that, they are going to get other incomes like in the form of rental incomes and all they are going to get. Then the banks, as we have seen, banks will keep their money as investments. Either that might be a CRR, SLR requirement or that might be excess funds. They keep that money in investments like bonds, government securities, sometimes shares, sometimes mutual funds. In various investments, they will block their money. From that, they will get dividend income. From that, they will get interest income. Yes or no? And not just that, they also perform various agency services. Agency kind of services also they are going to provide. Like for example, bills for collection. Bill discounting is different, bills for collection is different. So banks also offer the services of bills for collection. On behalf of their customers, they collect the money from their respective customers and they charge a commission for that. So this I broadly call them as agency services. From that agency services also you are going to get the agency income. So all this incomes also we are required to verify. All these incomes also we are required to verify. We are going to see how we are going to verify all that incomes. Now talking about expenses, tell me what is the major expense of any bank? Once again, the major expense of any bank is interest only. So they have to pay interest. They will not pay any interest on current accounts. They are not supposed to pay. But some banks are doing it today in the recent times, offering some very minimal interest on current accounts. Also, they are offering to attract the customers and all. But generally, current interest from current accounts is very minimal component. Savings account, in the savings accounts they will pay a significant amount of interest, and when it comes to major interest component, it will be on fixed deposits or recurring deposits. That is where the major chunk of interest will go. Apart from that, they have to incur regular expenses for running the business, like salaries they have to pay, maintenance will be there, rental expense will be there. So all that regular expenses they have to pay. Taxes will be there. They are required to pay the taxes. And not just that, one more expense is once again here, provision for NPA provisions also will be there. Prudential norms we call it. So that NPA provisions and all also will be there. So all this expenses also we are going to verify. This chapter is going to guide us how to verify all that expenses also. Apart from that, one major thing which we need to verify is, as I've told just now, prudential norms. So what are prudential norms? Asset classification. So Banking Regulation Act says we need to classify the assets on the basis of their recoverability. So broadly two categories, standard and NPAs. Standard and NPAs. In the NPAs, further classification, like we have something called substandard, we have something called doubtful, we have something called loss assets. So like that, different categories will be there. Depending on certain number of days overdue and certain conditions, this NPA classification will happen. This is where major manipulations also will take place. This is where fraudulent financial reporting will happen. Misappropriation will happen in all other areas. Like as I have told, two kinds of fraud. What are the two kinds of fraud? Fraudulent financial reporting, misappropriation of assets. See, in areas like cash, in all those areas, misappropriation will happen. But fraudulent financial reporting, that means giving a wrong picture through the financial statements that banks will try to achieve by not complying with prudential norms, this asset classification and provisioning requirements. So this is a highly risky area, particularly for which kind of fraud? Fraudulent financial reporting. So here we have to pay more focus. So we are also going to see that prudential norms also. How to verify that prudential norms also we are going to verify. So this is all the major part of the chapter. This is what some 90% of the chapter. At last we have a small concept called concurrent audit. We have something called what? Concurrent audit. So nowadays the banks are also having something called concurrent audit. How the concurrent audit is different from the regular audit? So it happens on a continuous basis. Like an auditor will come to you as a regular employee on a daily basis. He will verify the transactions of the banks. So that is what we call it as concurrent audit. And this concurrent audit is currently not mandatory for all kinds of banks. It is only mandatory for a few banks. So we are going to talk about that concurrent audit and how do you verify certain items as a part of your concurrent audit. That also we are going to see. That's all. If we discuss that concurrent audit concept, entire bank audit chapter will come to an end. This is what the entire introduction for the chapter. This is what we are going to learn. This is what is expected from you from this chapter. So now we will go into the details. We will pick up each and every aspect and we will try to see what we will verify, what we will not verify. The chapter might look very lengthy. So somewhere around 39 pages of the chapter is there in the material, but it will not take that much amount of time. So we can easily wind it up. Okay, because there is no much concept. Whatever concept is there that I have already explained. This is the only concept which we have. The rest of the things are, we need to go into the details, each and every aspect, what things we need to verify, what aspects we have to pay attention. That kind of information will be there. So that we will try to cover from the material. So here and there, wherever concept gets involved, that we will try to discuss with the practical examples and get comfortable with this chapter. Okay, shall we do it, everyone? Right. So let us do it. Fine. Maintain silence. So let us see the first part here. So what they are saying, characteristics that distinguishes banks from most other commercial enterprises. As I've told, why banks are different from other commercial entities. What characteristics make them different? We have already seen a few. Let us try to elaborate on this. Number one, custodian of large volumes of monetary items. So people trust the banks, they keep their money and money related items with the bank. Like even people go and keep their important documents with the lockers of in the lockers of the bank. They keep their gold and jewelry in the lockers of the bank because they have that much trust on the bank. So they are custodian, they are protector of large volumes of monetary items. So custody of large volumes of monetary items like cash, negotiable instruments, they require physical security, and both in storage and also in transfer, making banks prone to misappropriation and fraud. This necessitates formal operating procedures, defined limits on individual discretion, and a strong internal control system. That means there should be proper segregation of duties, proper internal controls must be there in the banks. Next, they deal with a large volume of transactions, definitely, than when compared with other entities. Here the volume of the transactions is very large. Once again, thanks to this internet banking, online banking, UPI transactions, today on a daily basis, the volume of the transactions of a bank might reach in lakhs and crores of transactions will happen in a single day. So huge volume of transactions than when compared with the other kind of entities. Then wide geographical spread. This we have already told, they have a very wider network. They are spread across all the remote countries of the world. We will have a banking place. So they operate through a wide network of geographically dispersed branches and departments, which necessitates greater decentralization of authority and dispersal of accounting and control functions. So generally you can't, when so many branches are there, you can't run everything from the head office only. So that's why what they do, they delegate the powers to the branch managers, branch heads. They have a various or different organizational structure. Regional heads will be there, area heads will be there, branch managers will be there. So like that, they have decentralized the operations. So because it becomes extremely difficult to run all the business from the head office, so that's why they have done the decentralization. Next, commitments without a transfer of funds. I have already explained. What are the commitments without transfer of funds? Bank guarantees, letter of credits. This is a unique feature of the banks. They do some major business without actually involving the funds and all. So this we broadly call them as off balance sheet items. What do we call them? Off balance sheet. Because as I have told, they will not come directly in the balance sheet. They will be mainly coming under contingent liabilities. So commitments without transfer of funds, assumption of significant commitments without transfer of funds, known as off balance sheet items, may not involve any kind of accounting entries, and their non-recording can be very much difficult to detect it. That's what happened even in the PNB scam also. Without the bank management's notice only, crores of letter of credits were given, already given. Even the bank's management itself is not aware that they have issued that many letters of credit. So if something has failed to get recorded in the books of accounts, especially these off balance sheet transactions, it becomes very difficult to detect. Then transactions at multiple points. Just now as I've told, you sit in the classroom, you initiate a transaction, and the bank will receive the information from the bank server. The transaction will get processed and the amount will go and get credited to the other party. So transaction is happening at multiple points. All the parties are not at one place. You are all at different places, but everything is getting connected. So transactions at multiple points. Then no intervention in the transaction. There is no human involvement. There is no bank employee approval. Today, if you want to transfer the money through UPI, do you need approval of any bank employee there? No. Without human intervention, the transactions are happening. And international settlements. As we have told, if we do foreign transactions also, their international settlements also will be required. But because of that, it could pose a systematic risk. Systematic risk means this kind of exchange rate risks and all, they might be facing it. Next, strict regulatory environment. As I've told, all this banking environment is very strictly regulated. Who is the regulator? RBI is the regulator. So tell me, what are the characteristics that distinguish the banks from other commercial enterprises? Number one, custodian of large volumes of monetary items, large volume of transactions, wide geographical spread, commitment without a transfer of the funds, transactions as are happening are multiple points, no intervention in the transactions, international settlement, and strict regulatory environment. Good. Now let us come to next one. Special considerations in audit of banks. So will you take any important care or special things will you keep in mind while doing audit of banks? Yes. Why? Why special considerations arise only in audit of banks? Why not in other organizations? Like as I have told, risk is high, reputational risk is high, volume of transactions is large, they are rapidly using the technology. So without manual intervention, the transactions are happening. So basically, whatever we have told the characteristics of the bank, that itself we can write. So those are the points because of which special consideration is required for banking kind of organizations than when compared with other enterprises. So that is what this aspect is about. Special audit considerations arise in the audit of banks. Why? Because of the particular nature of risk associated with the transactions undertaken. So depending on the transactions the banks are undertaking, different kinds of risk banks have to face. Like if we have to give you a few examples, the banks will face something called market risk. That means the people for sometimes the bank will give loans to certain sectors. If you take real estate sector is a highly risky sector. Sometimes what will happen is entire real estate sector might be going through a bad phase, and the bank which has given loans to the industries which are in the real estate sector, they will not be able to realize it. So this kind of market risk they will face. Sometimes they will face liquidity risk. What do you mean by liquidity risk? Unable to meet their payments. So sometimes many demand requests will come from the customers. So they have to honor the payments of all their deposit holders on time. If they don't do it, that will be a bigger risk for any organization. So that we call it as liquidity risk. See, this was faced in S Bank a few years ago. When something is going very bad something was going very bad in the S Bank, people have started withdrawing a lot of their money from the bank. But bank will not have all your money kept idle. Bank will invest all your money at different places. If all the customers come and start withdrawing their money, the bank will not be able to do it. It will not be able to give them the money because their money is already blocked in some investments. So many people have started withdrawing the money from the S Bank because of fear. And S Bank was not able to honor. This created even more fear. When bank is not able to give you money, this will create more fear, no? So at that point of time, somewhere in the year 2022 or 21, RBI has to interfere and they have imposed something, a daily limit. RBI has imposed a limit that if you are a S Bank holder, you will be able to withdraw only 10,000 rupees. Either through ATM, either you go to the bank or whatever you do, daily you are able to withdraw 10,000 rupees only. RBI itself has put a limit because it is creating more panic. Many people are coming because of the bad news is circulating. They are worried about their money. They are withdrawing the money, but bank is not able to give it. When bank is not able to give it, once again loop will start. It will create more fear. So RBI has to interfere and put the restriction. So these kind of liquidity risk also will be there. Scale of banking operations and resultant significant exposure that result within a short period of time. So bank is doing operations at a very larger scale and something can turn it into very bad. That too, it will not take much time for that. Then extensive dependence on information technology. The banks are hugely relying on the information technology for their day-to-day operations. The effect of statutory and regulatory requirements. As I have told, whatever characteristics they have told above, because of that only we need special consideration. That only they are saying it, nothing else here. Then continuing development of new products, services, banking practices may not match with concurrent development of accounting principles and auditing practices. Today banks are innovating new products and all. So against your shares and securities also they will give loans against shares also they will give a loan. So this is altogether some new kind of product every bank is trying to do it. This is a new product. But the way the banks are bringing up new products, in the same manner accounting principles are not getting developed. So we have to give new accounting and auditing practices for new products. But since everybody is so well versed, today the market is very dynamic. People are bringing products just like that. New innovative products they will bring. But how to do the accounting of that new products, how to audit that new products, it will take some time. So new products are coming very fast, that new developments in accounting and auditing are not coming that fast. That's why also, because of that time lag also, it is becoming extremely difficult for us to do audit in banks, and that's why we need to pay special attention here. Then evolution of technology and providing services through net banking and mobiles has exposed banks to huge operational and financial risk. Definitely, because of this net banking and all, from wherever you want you can do the transaction. That will give you the risk, that will give you operational risk also, financial risk also. That's why this today cyber frauds are so high. So people are looting our money. Previously, if the people have to do the looting and all, so they used to be the people, they have to come to your home, break your walls, break your cupboards, and they have to steal the money. So now people sitting in the AC cabin with a computer on hand, they are looting your money. So cyber criminals are there. So because of this banking, net banking and all, it is giving rise to new financial risk and operational risk. And banks use multiple applications for different transactions involving data flow from one app to other. Auditor shall understand interface controls. That means today banks are using multiple softwares. Say for example, there will be something called loan processing app. When you want to get a loan from the bank, they will have a different software for that, where they will ask your details, interest rate and all they will do. They will document all the whatever documents are required. You have to submit in that loan processing app. Now once the loan has been dispersed, the core banking solution software will be there. No, that CBS is connected with that loan software, loan generating software. So now once a loan has been successfully disbursed, now there should be connection between that loan software and CBS. Data should flow from the loan software to the core banking software. Same thing with the credit cards also. Credit cards, for managing the credit cards and all, they have a software. Now that credit card software should be integrated with the core banking solution, so that data will flow in a proper manner and it will be recorded properly in the core banking software. Core banking software is the heart of it. And we have all these other softwares which are other organs of the body. Now they need connection in the form of that vessels and all. So we have that nerves and all. So that is the way how the banks will function. So all these multiple applications are connected to the core banking solution and data should flow in a proper manner. So there also some manipulations are happening. Like if I tell you PNB scam, what exactly the root cause of that is? See, whenever international transactions are happening, those international transactions will happen by way of SWIFT. There will be something called SWIFT code and all will be there. SWIFT is actually a software for processing the international transactions between the banks, if I put it in simple terms. So what people used to think is, whatever transaction that will go in the SWIFT, that will route through SWIFT, that will get automatically recorded in the core banking solution. But somehow in this PNB scam, the people are able to find a way out where they are giving letter of credits for foreign imports and all. That means through SWIFT software, they are generating the letters of credit, but those letters of credits are not recorded in the core banking solution software. So somehow connection was broken between SWIFT and CBS. So that's why even PNB management was also not able to realize that they have issued 11,400 crores worth of letters of credit they have given. They are not even able to realize. Why? Because that is not there in core banking solution. Every letter of credit, every international letter of credit, they have routed through SWIFT, but somehow the connection between that SWIFT and CBS was broken and this was not recorded anywhere. So that connection between the things is very important. So if that is not happening, this completely assets will be wiped out of the bank. Next. So this is also one risk because of which we need special consideration. So auditors should consider above factors in designing their audit approach. Branch auditors and statutory central auditors must have a detailed knowledge of products which are getting offered, from that product what risk is getting generated, and address them in the audit plan where they pose a risk of material misstatement. So wherever you find the risk of material misstatement, you need to respond to that risk. How do you respond to that risk? By performing the further audit procedures. Next. This one. Legal framework for banks in India. Basically, what laws and regulations the bank has to comply with in India. Numerous laws and regulations. There is no shortage of laws and regulations applicable for banks. We have many laws. The list has been given here. I think I need not read it. Just the list is there. List of laws and regulations which is required to be complied with. So this is the list of laws and regulations like Banking Regulation Act, RBI Act. For SBA altogether, we have a separate act. Payment and Settlement Systems Act, which governs this NEFT, RTGS and all this kind of transactions. Credit Information Companies Regulation Act 2005, which governs this credit score, CIBIL scores and all which the banks are offering. Securitization and reconstruction of financial assets, nothing but selling of the bank's loans. In the securitization, what will happen is whatever loan bank has given to the customers, they can sell it. I will talk about it later. We have a concept called sale of NPS and all. There we will see. So that will be governed by the securitization and reconstruction of financial assets and enforcement of securities interest. So that we call it as SARFAESI Act also we call it. And the main reason for 2008 global recession is that securitization. One of the contributing factor for that 2008 recession is that securitization and refinancing. So that is because of this, not because of this act. This act contains how to overcome that, but the concept of securitization has actually led to the 2008 crisis. Next, prevention of money laundering. So banks are vehicles for this terrorist funding and all, and there's a drug cartels. Through that also this money laundering can happen. So prevention of money laundering act has to follow. Information technology, since they are the biggest users of technology, they have to comply with Information Technology Act. Banking companies acquisition and transfer of undertakings. Today acquisitions and mergers are happening. That too especially in PSUs. Public sector banks are getting merged a lot. Like Union Bank, Andhra Bank has been merged. So for operational difficulties, what the government is doing is they're doing mergers and all. So that all mergers are governed by this Banking Companies Acquisition and Transfer of Undertakings Act. Then we have for RRBs, we have altogether a RRB Act. Next, talking about firm and content of the financial statements. Guys, is the discussion sounding fast? There is nothing here significant for me to explain. So that's why I'm a little bit fast. Wherever concept is there we will slow down definitely. So wherever the things feel complicated, automatically I will slow down. Here there is nothing required for me to slow down here. Next. Form and content of financial statements of banks. So how do they prepare the financial statements? We already know it, right? As per Banking Regulation Act. So in the Banking Regulation Act, there is a third schedule. In the third schedule, two forms are there. Form A governs how to prepare the balance sheet. Form B governs how to prepare the P&L account. And also banks must comply with all the disclosure requirements under AS. Why? Because Ind AS is not yet applicable. Till that point of time, they have to continue to comply with accounting standards only. And even they are required to give disclosures as per Companies Act 2013, companies rules, and also if any disclosure requirements are given by ICAI, they have to give that disclosure requirements also. And RBI has a deferred implementation of Ind AS for all scheduled commercial banks. As I've told, they have deferred it. They will notify a date in the future. From that date, they need to comply with Ind AS. And recent developments, we are able to see that this is going to come sooner because they are educating, and so much of thing is happening in the background to make the banks ready to comply with the Ind AS. So very soon we will see it. Next. Bank balance sheet preparation includes both standalone and consolidated. Since banks is having so many subsidiaries today, they have to prepare consolidated financial statements, and also they should prepare standalone financial statements. And standalone financial statements require consolidation of branches, verticals or departments. So standalone, when you even look from the standalone perspective also, you have to merge all the branches related information. Procedures vary by bank. Private banks have centralized accounting and no mandatory branch audits as per RBI guidelines. But PSU banks and nationalized banks, they must have separate branch auditors. Public and private sector banks listed on recognized stock exchange, in addition to complying with all the above rules, they should also comply with SEBI regulations, including LODR regulations. So this is what regarding form and content of financial statements of the bank. Now talking about audit of accounts and appointment of auditor. So who will appoint the auditor? First of all, who is eligible to act as auditor of bank? They say that who is eligible to act as auditor of a company, the same person will become eligible to act as auditor of a bank. So what Companies Act says is an individual who is a chartered accountant and holding a certificate of practice, or a firm of chartered accountants in which majority of the partners are practicing chartered accountants. I told you that majority also, exactly 50% is not majority, you should have more than 50%. So whoever is eligible to act as auditor of the company, the same person will also become eligible to act as auditor of bank. But however, what RBI has suggested is you need to go for joint audit. So they have told better, RBI has given a suggestion in case of banks and all, like if you see here, third point, if you see, most banks, especially those in the nationalized banks or public sector, appoint 4 or more depending on the size, board decision, RBI guidelines, firms of chartered accountants to act jointly as statutory central auditors. They're not talking about branch auditors. Branch auditors are different. For every branch, branch auditors will be there. Now these branch auditors will prepare the report of the branches, and all these reports will go to someone called statutory central auditor. Those statutory central auditors, especially in the case of nationalized banks, they have to appoint minimum 4 or more number of joint auditors. Like as I have told, SBI is having 14 joint auditors. Some other nationalized bank will have certain number of joint auditors, but minimum 4 joint auditors they will generally appoint it. Sir, now who will make an appointment of an auditor? So in the case of a nationalized bank, in the case of nationalized banks, then their auditor will be appointed by their board of directors. Normal procedures will follow that. Board of directors will appoint them. However, in the board of directors, nationalized bank board of directors. For normal banking company, AGM, that is governed by the normal provisions of the Companies Act. But in both the cases, whose approval is required? Reserve Bank approval is required. So nationalized bank, the auditor will be appointed by board of directors. Banking company, the auditor will be appointed at AGM, that is by the shareholders. But in both the cases, whose prior approval will be required? RBI's prior approval will be required. Next, appointment letter sent by bank for appointment of statutory central auditors typically contain the following. So are they talking about engagement letter here? No, not engagement letter. Because they're talking about appointment letter sent by banks for appointment. When the banks are appointing the auditor, they send the appointment letter. But engagement letter is something which has to be prepared by auditor sent to the bank. So this they are not talking about engagement letter. Generally, bank will send one formal appointment letter for the firms. Sir, you are appointed as auditor of our bank, as a statutory central auditor of our bank. So stating that, they will send one appointment letter. So this is something which is different from engagement letter. Engagement letter will be governed by SA 210. Like what contents should be there in the engagement letter and all, that will be governed by SA 210. So they are not talking about engagement letter, they are talking about appointment letter. So bank will give appointment letter to their statutory central auditors, and what information will be there in that appointment letter? Number 1, period of appointment, for what duration they are appointing him as an auditor. Particulars of other central auditors. As I have told, joint auditors will be there, no? You should inform along with you who are that other joint auditors conducting the audit. Particulars of previous auditor. Who are the previous auditors? Procedural requirements to be complied with in accepting assignment. So sometimes there will be some procedural formalities you have to fulfill if you want to accept a position as an auditor. Like one we will see later, you are required to declare something called declaration of indebtedness. You are required to give. That is one formality. In the case of audit of bank, you need to issue a statement called declaration of indebtedness. That is one formality. Unless you give that declaration of indebtedness, your appointment will not be valid. So bank will list out what are that procedural formalities which you have to comply in accepting the assignment. Then a statement of division of work. If there are joint auditors, generally work will be divided, no? That statement of division of work and what are your reporting responsibilities, all that will also be mentioned in the appointment letter. And also what is the scope of assignment, which includes any special reports or certificates to be given by statutory central auditors. It will also mention what is your scope, what reports you are required to give, what certificates you are required to give. That will also be included. In case of statutory branch audit, appointment letter is similar to that of other auditors. In the case of branch auditors also, they will give the appointment letter. But what will not be there in the branch audits? There will be no concept of joint audit. Branch audit will be done by one individual or one audit firm only. So the details of branch audit, division of work, all that information will not be there. Rest of the details will be there. So in case of statutory branch audit, appointment letter is similar to that of auditors, that is central statutory auditors, except it excludes particulars of other auditors and division of work. Why? Because branch audit will not be a joint audit. It will be a normal audit only. So that's why this division of work, details of other joint auditors will not be there. Apart from that, all other information is going to be there. Understood? Right. So what and all concepts we have covered till now? Tell me. Number 1, special characteristics of the bank. Then number 2, why special considerations are required while conducting the audit of the bank. Number 3, we have seen legal framework, what laws and regulations are applicable while conducting audit of banks. Then what is the form and content of financial statements of banks. Then who will be eligible to act as an auditor and how that auditor will be appointed. And then we have seen, that's what we have seen. Then we have one more thing called various stages of conducting an audit of the bank. This we will try to understand. That means they will give an entire overview of the audit. What and all you are supposed to do in the audit from the beginning till the ending, what and all you are supposed to do. They will give a complete overview of audit of banks in this particular question that we will try to understand. After that, we will take a break. After the break, we will resume, but before that, we will try to complete this. So the concept might look very lengthy, but very easy concept. They say that whenever you are conducting the audit of a bank, it involves 5 phases or 5 stages will be there. So what are that 5 phases? Number 1, some initial considerations. Stage 1, initial consideration. Stage 2, understanding. Stage 3, risk assessment. Stage 4, execution. And finally, reporting. Right. So tell me, what are the 5 stages of the bank audit? Number 1, initial consideration. Number 2, understanding. Number 3, risk assessment. Number 4, execution. Number 5, reporting. So these are the 5 stages of conducting the bank audit. Now talking about initial consideration. That means even before you accept the audit, before you start doing the audit, there are some considerations which you have to keep in mind. More or less similar to preliminary engagement activities, you can say. More or less related to preliminary engagement activity. Like as I have told, before accepting or continuing a client relationship, you have to evaluate certain factors. 4 factors you have to evaluate. Evaluating integrity, compliance with ethical requirements, competence of engagement team, significant matters that have arisen during the previous audit assignments. That we have to do it even in the audit of banks also or not? Yes. So we need to decide whether we can accept a client relationship or not. Then you need to give engagement letter. Engagement letter is also required even in the audit of banks. So drafting an engagement letter. And also you try to perform something like declaration of indebtedness. As I've told, in case of banks, RBI told that before you can get appointed as an auditor, you need to fulfill one formality. What is that formality? You have to give something called declaration of indebtedness. In that declaration, you have to mention whether you or any of your key engagement team members are indebted to the bank, or whether at any point of time your account has been classified as NPA. That declaration of indebtedness you have to give. Communication with the previous auditor. You have to do clause 8 of part 1 of the first schedule. So you have to communicate with previous auditor. That is also one of the formality which you have to complete it even before you accept the audit. So all that formalities we will do. All this will come under initial consideration. Then comes understanding. So what do you mean by understanding here? What and all you will try to understand? You will try to understand the entity. You will try to understand in what environment your bank is operating. You will also try to understand their internal control. Basically, you try to perform risk assessment procedures. You will try to understand. Now, from that understanding, what we will get to know? What is the purpose of that understanding of entity, environment and its internal control? To identify and assess risk of material misstatement. So that risk analysis that they are saying it in the third part. We will try to do the understanding of entity, environment, how they are managing the risk, all that we will try to understand. The objective of doing that understanding is we want to identify and assess the risk of material misstatement. So whatever risk we have identified, that we need to analyze it. We need to identify inherent risk. We need to identify control risk. We need to calculate our detection risk. We need to divide that risk at 2 levels. What is the risk of material misstatement at the financial statement level? What is the risk of material misstatement at the assertion level? So all that analysis we have to do it or not. So that is a risk assessment part. Now, once you have identified and assessed the risk of material misstatement, then what you should do? Execution. Actual execution should come into picture. Like now you will start performing, deciding materiality, drafting a detailed audit program, execution of the audit procedures, further audit procedures, compliance procedures, substantive audit procedures, analytical procedures, test of details. All that execution we will do. We will perform procedures. We will obtain evidence. Now, final part. So whatever evidence we have obtained, on that basis we will form an opinion, and whatever opinion that we have formed, that opinion need to be expressed in the form of a written document. That written document only we are going to call it as audit report. That's all. That is the final stage, which is reporting. Okay. So tell me guys, what are the 5 stages of conducting the audit of banks? Initial consideration, understanding, risk assessment, execution, reporting. Let us see what happens in each stage in a detailed manner. So like if you come here, First one, initial consideration. What is the first thing they are asking you to do? Acceptance and continuation. Like, what is the risk of this engagement? Whether I should accept this engagement or not. Am I competent enough? Will I be able to comply with the ethical requirements? Did I have any significant matters during the previous audit? So mainly paying attention to the risk in that engagement. I will try to decide whether I should accept the engagement or whether I should continue the engagement or not. That decision I have to take. Then declaration of indebtedness. As I have told, it is a RBI's advice. RBI advised that the banks, before appointing statutory central auditor or branch auditor, for every auditor this requirement will become applicable. So before appointing central or branch auditors, the banks shall obtain a declaration of indebtedness. That is a written confirmation that auditor, firm, partners or family members, that is relatives, they have not been declared as willful defaulters by any bank or financial institution. This is in addition to declaration regarding absence of disqualification under 141. See, under section 141 we have a disqualification. If you are indebted for more than 5 lakh rupees, or if you have given any guarantee or security on behalf of other person for an amount exceeding 1 lakh rupees, you will be disqualified. So that declaration you will give regarding you are not disqualified under section 141. In addition to that, you have to give this declaration of indebtedness that none of you, your firm, your partner or any of your relatives have been declared as a willful defaulter. Next, internal assignments by statutory auditors. Once again, section 144 prohibited, or any other internal services you should not provide it. So you should check before accepting appointment that you are not doing any internal audit assignments either by you, by your associated concerns or your network firms. Once again, all the council guidelines you have to check here before accepting the audit. Next, terms of the engagement. So what do you mean by terms of engagement? So whatever terms and conditions of the engagement, like what are your responsibilities, what are client's responsibilities, what is your scope of audit, fees, all that things we have to draft it. That drafted document only we call it as engagement letter. So as per SA 210, you have to agree on the terms of the engagement, and that we generally documented, that we call it as engagement letter, which is prepared by the auditor, given to the bank and get a confirmation by way of signing of the management there. Next, communication with previous auditor. This is a requirement of the professional ethics, clause 8 part 1 first schedule. Then we will spend some time on planning. So audit plan needs to be properly documented with regarding to nature, timing and extent of checking of audit procedures. And we have to decide our engagement team. That means our firm will have so many people, but as I've told, I will not take every person for every engagement. So out of my existing engagement, which person I have to take it for this bank audit? Should I take experienced staff? Should I take less experienced staff? Should I take article assistants, or should I go with paid? Should I go with paid assistants? So all these things you need to establish your engagement team. So these are the 7 steps involved in initial consideration. What are they? Acceptance and continuation, declaration of indebtedness, no internal assignments by stat auditors, establish the terms of the engagement, communicate with previous auditor, plan your audit, establish your engagement teams. Now we have to start understanding. Second phase, sir, what I should understand? You should understand the bank, its environment, including its internal control. Sir, what will happen if I understand that? You will be able to identify and assess the risk of material misstatement, and on the basis of that risk you can develop an audit plan to determine whether controls are working effectively or not. So you can betterly plan your audit. You can identify the risk and do the better planning of audit. Then you should also try to understand bank's accounting process, how they are passing the accounting entries from a transaction, how the transaction is getting converted into entry in the books of accounts. If a customer has come for withdrawal of money, from that point, how that withdrawal was recorded in the books of accounts, in between what and all softwares are involved, in between what and all people are involved, in between whatever internal controls are involved, everything I need to understand. So you need to even obtain understanding of their accounting process being followed. So accounting process produces financial and operational information for management's use, and it also contributes to bank's internal control. So that's why it is necessary to identify and risk of material misstatement due to fraud or not, and to design, perform further audit procedures. So in addition to understanding the bank's accounting process, you should also understand the risk management process, how the bank is managing the risk. So bank will have different kinds of risk, as I have told, depending on the transactions in which they are engaged, different kinds of risk will come. Now, how the bank is managing that risk, what process the bank is following for managing the risk, that I need to understand. You tell me how the bank will manage the risk. By implementing internal controls. So that only I will try to understand how the bank has implemented the controls for managing the risk. This part is important. They might ask a question only from this. Right. So management develops controls and uses performance indicators. They try to have some indicators to help to aid them in managing key business and financial risk. So how generally banks will manage the risk is by way of how banks generally management what they do, they develop the controls and they use some indicators to help them manage their risk. An effective risk management system in a bank generally requires the following. If you expect the risk management system in the bank to work properly, then that system must have the following characteristics. As an auditor, if you have to conclude whether the risk management system of the bank is effective or not, we need to test for these characteristics. What are that characteristics? Number one, oversight by those charged with governance. First, I will read the side headings, then I will give you. So first, oversight by those charged with governance. Identification, measurement and monitoring of risk should be there. Control activities should be there. Monitoring activities should be there. Reliable information systems should be there. Don't you think the first 4 points are sounding familiar? Somewhere we have seen them. Oversight by those charged with governance. Exactly. Identification, measurement and monitoring of the risk. Control activities, monitoring, these are all nothing but components of the internal control. 5 components of internal control are there, which we have read in the risk assessment and internal control chapter. Number 1 is control environment. Number 2 is entities risk assessment process. Number 3, control activities. Number 4, information systems related to relevant business processes. Last one is monitoring. The same 5 items are given here. So controls will be effective when these 5 components are followed. Yes or no? I have told you in the risk assessment chapter, when these 5 aspects are there, when these 5 components are there in the internal controls, that means controls are working effectively. If I say risk management system in the bank is effective, risk management system is nothing but internal controls. If I have to say that whether bank is having effective internal control or not, there also I need to check these 5 elements only. Number 1 is what? Control environment. That is what? Creating a good culture of honesty and ethical behavior. If you remember in the risk assessment part, under control environment, we have seen various elements, how a good control environment will be created. In that, one of the point will be participation by those charged with governance. The more those charged with governance participate in the business, the better control environment will be created. That's what the first point they are saying. The risk management system in the bank will be effective. When it will be effective? When that is getting a oversight by those charged with governance. That means when it is getting monitored, when it is getting looked after by those charged with governance. Nothing but this first point is going to talk about the control environment. Indirectly, they are trying to talk about control environment. So those charged with governance should approve written management policies. Policy should be consistent with business objectives, risk strategies, capital strength, management expertise, blah blah blah. So basically management should give that policies. What risk management policies bank has to follow, that should be managed or given by those charged with governance. Basically this aspect is related to control environment. This creates a good control environment. Then identification, measurement, monitoring of risk. This only we called as entities risk assessment process. This only we called it as entities risk assessment process. So the organization the bank's management should study about their own organization. They should identify where there is a risk. They should measure that risk. They should monitor that risk. Once they know what risk is there in the organization, then only they can implement controls. So as an auditor, I should see whether the bank is properly identifying, measuring, monitoring that risks or not. Then third one, control activities. So what are control activities? Now we will start implementing appropriate controls like performance reviews, comparisons of actuals versus budgets, segregation of duties, general IT controls, application controls. That control activities are there or not, I need to check. So bank should have appropriate controls to manage its risk, including effective segregation of duties, accurate measurement and reporting of positions, verification and approval of transactions, reconciliations, approvals, physical security and all. Same control activities. All the controls are there or not, I need to check. Then we need to monitor. Just implementing the controls alone will not be enough. We need to continuously monitor it. Is the control working as expected? Are we required to make any changes? That monitoring is also required. And one more component, information system, as we already know it. See, today the banks are all working through technology. Even the controls are also getting implemented through technology. If you expect the risk management to be effective, if you want that controls should be effective, then the bank should be using the most reliable information system. If the bank is trying to rely on weak information system, if they are using some cheap softwares without investing much on that, can you expect that risk management system or controls to work effectively? No. So that's why whether the risk management system is effective or not, one more factor which is going to decide is whatever information system, whatever softwares the bank is using, are they reliable? Are they effective? So this is very important. So how they will ask the question is, the management should have, they will ask a question something like this. So management will have internal controls and have performance indicators that aid them in managing the risk. So as an auditor, how you will decide whether risk management system of the bank is effective or not? As an auditor, how you will decide whether risk management function of the bank is effective or not? They will ask a question in this way. So then we have to write this. So we will expect the risk management system of the bank is effective when there are 5 things. What are they? Number 1, repeat, oversight by those charged with governance. Number 2, identification, measurement, monitoring of the risk. Number 3 is control activities. Number 4 is monitoring activities and reliable information system. I did not teach anything new. Just if you got clarity, if you still have in your mind that concept of components, that only I have revised here. That only I have summarized here. I did not teach you anything new in this risk management function. Understood? So second aspect, that is understanding is done. All this we will understand. From doing this understanding, what is my outcome? Risk assessment. I will try to identify and assess risk of material misstatement. So identifying and assessing the risk of material misstatement. SA 315 requires the auditor to identify and also assess the risk of material misstatement, that too at 2 levels, at the financial statement level and also at the assertion level, for class of transactions, account balances, disclosures, to provide a basis for designing and performing further audit procedures. Why we are assessing the risk? Because depending on the risk, we will try to plan our further audit procedures. And one more thing they say here, in the banks, particularly you need to identify, is there any risk of fraud relating to money laundering? As I've told, banks are getting used as vehicles for money laundering transactions like terrorist funding and drug cartels and all. So you need to identify, especially in the banks, since the chance is always there for doing money laundering, you should always try to pay attention and try to identify, is there any risk of fraud, especially related to money laundering, right? So as per SA 240, auditor's objective is to identify and assess risk of material misstatement in the financial statements due to fraud. And once you have identified the risk, you need to obtain sufficient and appropriate audit evidence, and you have to respond appropriately. Attitude of professional skepticism is required, especially if you want to identify a misstatement due to fraud. If you want to identify the fraud without professional skepticism, you can't do it. So professional skepticism is a must if you want to identify the frauds. And also RBI has framed specific guidelines that deal with prevention of money laundering and know your customer norms. Especially to prevent this money laundering activities, RBI has devised some guidelines called KYC norms, know your customer. The bank should maintain entire database for your customer, because as a bank you should know whom you are dealing with. Are you dealing with a genuine person? Are you dealing with a scammer? Are you dealing with a terrorist? You need to know it. So that's why bank has framed this KYC guidelines exclusively to prevent that money laundering activities. So RBI from time to time issued guidelines, KYC guidelines, anti-money laundering standards requiring banks to establish policies, procedures and control to deter, to prevent or to recognize and report money laundering activities. So as an auditor, I need to check whether all that policies given by RBI are getting followed by my client or not. Then you need to assess specific risk. If you find any specific risks which are only suitable for banking industry, specifically some risk will be there which will be there only for banking industry. Like for example, one of the major risks which banks will have is foreign currency risk will be there, exchange rate risk will be there. This is very unique for the banks and all. So like that, if there are any specific risk keeping in mind the banking industry, you need to pay more attention for that. So assess specific risk. Auditor should identify and assess specific risk of material misstatement at the financial statement level, which refers to risk that related to banking industry and use of information technology therein. And also risk associated with outsourcing. So today the banks are even looking for outsourcing. Previously other countries used to resource us to India. See how the outsourcing market actually works is, for a short period of time a country will flourish because of the outsourcing business. So these developed countries, when they get their routine activities done in the respective country, they have to pay higher amount for their people. For example, if US has to done their normal accounting operations in US only, in US standard of living is very high. You might be required to pay a local US staff 100, say for example, $50 per hour. That is required for their standard of living. But if you outsource that work to India, that might cost them only $20 per hour, because in India comparatively standard of living is low. So what these developed countries will do is, they will pick one country where the standard of living is low and reasonable skills and knowledge is there, reasonable talent is there. So this was a golden phase for India in the last, from the last decade. This was a golden phase for outsourcing. Why? Because in India we have reasonably skilled and talented people, and also the cost of living is low, and it is a developing country. So all these foreign companies started outsourcing that work to India. But this outsourcing will come to India only up to certain point of time. Why? Because when you start outsourcing the work, even the people's standard of living here, it will increase. You are creating employment opportunities, you are giving them the salary and all. After a certain period of time, the standard of living in this country increases. Then what companies will do is, they will start looking for other countries where they can once again find the skilled labor at low cost of living. So previous to India, Philippines was the golden phase. Philippines used to be that country where the resources used to be skilled and relatively cheap, but their standard of living has increased now. Now slowly business has moved from Philippines to India. Now once after, within the next decade, even our standard of living will get increased. Now India will not once again become good option for outsourcing. Now already some people have started exploring the South African countries where they can get some reasonably skilled staff with low standard of living. And today we have grown to some extent that even our Indian companies are outsourcing the work. So even some banks, not all banks are doing it. Some banks are even outsourcing the work. But as you know, whenever you are outsourcing, you are keeping the work in other person's hand. You are not doing it on your own. So definitely there will always be a risk or not. So that's what they say here. Modern day banks make extensive use of outsourcing as a means of both reducing the cost as well as making use of services of an expert not available internally. But however, the moment you do outsourcing, there will be risk which will get associated. First thing is confidentiality breach could be there. That is a major risk if you are outsourcing the task and all. And apart from that, they can do manipulation without your control. Like I told, that Revlon scam, do you remember? So there what happened, Citibank has outsourced their operations to Wipro in India, and error happened in Wipro, right? So risk there. So when you outsource the activities, these kind of risk could happen. Then, so 3 stages of the audit of the bank we have completed. First one, what are they? Initial considerations. Number 2, understanding. Number 3, risk assessment. Number 4, execution. Now once you have identified the risk and all, now you have to start doing the work. Execution is required. So what you do in the execution? Number 1, engagement team discussion. In every bank audit, before audit happens, you need to perform an engagement team discussion. All the engagement team members should discuss regarding what breakfast they have to eat, what lunch they have to eat, regarding that. No. So they have to have a discussion among the engagement team members regarding various findings, what should be their approach, what is the identified risk, what actions they have to take. So regarding that, they need to have a discussion. Then they need to respond to the assessed risk. How to respond to the assessed risk? By performing audit procedures. So SA 330 requires auditor to design and implement overall responses to address the assessed risk of material misstatement. And how he can respond that? By performing further audit procedures. Then you should establish overall audit strategy. I don't think it should come here. It should go previously only. But since it will be done after risk assessment procedures, that's why they have added it here. So we will establish our overall audit strategy. As we all know, prior to commencement of the audit, we will establish an overall audit strategy, and in the development of that audit strategy, we involve all the engagement team members, clients, management and staff also we will involve, but only to a limited extent. So that involvement also we will do. Then finally, audit planning memorandum, nothing but planning also we will do. Strategy alone will not be enough. On the basis of that strategy, we have to develop plan also. So we have to prepare a detailed audit plan. Just they use a different name. Audit planning memorandum, audit plan, both conveys the same meaning. So we will develop audit plan. In that we will describe what is the extent and scope of the audit procedures to be performed, highlight all the issues and risk identified, and also we will include the procedures that provide the evidence. So once we draft the audit plan, how to draft the plan and all we have covered in the audit strategy planning and program itself. Then we will determine materiality. So materiality fixation also we have to do know what is material, what is not material. That also we have to fix it. Overall materiality, performance materiality, benchmarks, percentages. So SA 320 we have to follow once again. So materiality we will fix. So auditor should consider a relationship between audit materiality and audit risk when conducting the audit. Determination of audit is a matter of professional judgment, and it depends on various factors that we already know. Judgments of materiality are made in light of surrounding circumstances and are affected by size and nature of misstatement or combination or both. What is material, what is not material? As I have told, what is material, what is not material, you have to decide it not just on the basis of size of the misstatement. You have to even pay attention to nature of the misstatement and also circumstances in which such misstatement has happened. So considering all the factors, you have to decide the materiality. And even you need to consider going concern assumption. SA 570 also you have to comply with. So these are all execution phase. So what we do in the execution phase? Come on, respond. We need to perform a engagement team discussion. We need to respond to that assessed risk, establish our audit strategy, develop a audit plan, determine the materiality, and consider whether going concern assumption is appropriate or not. Finally, after doing all that, we have evidence, we form an opinion. That opinion we are going to report it in the form of an audit report. In addition to that audit report, there are various other additional reporting requirements also. All that additional reporting requirements we will see it in the subsequent part of the chapter, but final stage is reporting. Understood? So these are the 5 stages of the bank audit: initial consideration, understanding, risk assessment, execution, reporting. Okay, so from this entire perspective, from this entire concept, where there is a chance of asking the question is, as I've told, risk assessment. From the risk assessment part, there might be a question. And one more thing, this specific aspect, as I've told, understanding the risk management process. So what things you will try to understand regarding the risk management process to determine whether it is effective or not. So these 2 things are important. They will not definitely ask you to write the entire answer. That they will never ask. No need to worry about it. But this specific parts can be tested. Okay, right. So now we will go for a break. We'll come back after the break and resume our discussion. Good morning, everyone. Right. So we are left with a very few concepts in that audit of NBFCs. So we'll try to complete that left out part from the audit of NBFC. We'll also try to solve the question bank. Then after that, we'll go into the subsequent areas. So before break, we will try to complete the left out areas. Okay, right. So the important discussion from the previous session, like whatever we have discussed till now regarding the audit of NBFCs. From all that, if we try to quickly revise what are the important things, whatever we have seen from the NBFC chapter. So number 1, the classification. How do you identify an NBFC? So there we have told one condition: when your financial assets are more than 50% of your total assets excluding intangible assets, and also when your income from the financial assets is more than 50% of your gross income, then we can consider that entity. Then that entity will be classified as NBFC, and the moment they are classified as NBFC, they need compulsory registration from the RBI. Then after that, so having said that, then next part which we have discussed is classification of NBFCs, which is going to be very important. So when it comes to classification of NBFCs, on the basis of deposit taking, they are broadly divided into 2 categories: NBFCs deposit taking, NBFCs non-deposit taking. And those NBFCs which are non-deposit taking, they are further divided into 4 layers. So number 1 is a base layer, middle layer, upper layer, top layer. So basically, which don't have access to the public funds, which are not having major risk, they all will fall under base layer. So then we have deposit taking entities and certain kind of entities which have a significant exposure. They fall under a middle layer. Upper layer, who will come under upper layer? That will be decided by RBI. Generally, they will keep the top 10 NBFCs under top layer category. And in some cases, RBI might feel that placing them in the top layer or upper layer alone will not be enough. So they need even more strict mechanism or strict control. Then they will move some NBFCs from the upper layer to the top layer. Right. So then after all that, talking about the significant discussion we had, which is capital requirements is a significant discussion. So the RBI, as per RBI regulations, you need to have a capital adequacy ratio of how much percent? 15%, comprising of both tier 1 and tier 2 capital. So you should have 15% of tier 1 and tier 2 capital of risk weighted assets and risk adjusted off balance sheet items. So then, in that also, other than NBFCs, microfinance industries, and NBFCs which are primarily lending against jewelry, apart from these two, you need to have tier 1 capital to the extent of 10%. You need 12% or 10%. 10% you need to have. For jewelry loans, 12% we need to have. So what will fall under tier 1 capital? That is very important. So we have to take the owned funds. From that, we have to reduce investments you have made in the other NBFCs or other group companies which are in excess of 10% of owned funds. Then we have to also add perpetual debt instruments to an extent of 15% of tier 1 capital as on 31st of March of the preceding year. However, if it is a NBFC which is in the base layer, you should not add that perpetual debt instruments. Then coming to tier 2 capital, what will be there in the tier 2 capital? You will have preference share capital, revaluation reserves to the extent of 55% you can have, general reserves you can have, and then subordinated debt, hybrid debt capital equipments, and perpetual debt instruments which are not falling under tier 1 capital. And also, if you are a NBFC which is in the base layer, you should not be adding that perpetual debt instrument in the tier 2 capital. So then after that we have discussed various things. Then comes a major part which is NPA part. We have seen asset classification and provisioning. That is a major part there. So like banks, here also they are classified into 4: standard, substandard, doubtful, and loss assets. So if the asset is everything in good and there is nothing irregularities happening, it will remain in the standard category. So when it will fall under substandard category? If it is a base layer, if it remained in NPA category up to 18 months. For middle layer and above, if it remained in the NPA category up to 12 months. After 18 months in the case of base layer, it will go to doubtful. After 12 months in the case of middle layer and above, it will go to doubtful. So loss assets are those which are identified by the management, auditors, inspections, etc., which are not recoverable at all. So provisioning requirements also we have seen. Yeah, so this is what the major discussion we had. So apart from that, everything else is a routine procedural formalities only we will have. So this is what the major discussion we had a study. And the last concept with which we have ended our discussion is what is a checklist. Basically, what are the list of all the items which you are supposed to check, which areas you have to focus. So that checklist we have seen. What should be the checklist in the case of audit of NBFCs. So please keep your mobiles on the silent mode. So now we will talk about what and all are the duties of the auditor. What and all are duties of auditors of NBFC. So here when I say duties, they will mainly talk from the perspective of the reporting requirements. They will talk mainly from the perspective of what? Reporting requirements. There are various matters. RBI has given clear guidelines on the matters which are required to be reported by the NBFC auditors. They told that first you are required to prepare one normal audit report. You are required to prepare, like in case of any other entity, like the way you prepare the normal audit report, and as per the standards on audit, that audit report you have to prepare. Why? Because NBFC is also a company. It is also registered under Companies Act. So you need to prepare first normal audit report you have to prepare. But in addition to that, there is one report which you are required to send it to Board of Directors. RBI has given directions. In that directions, they have given a list of matters. The auditor of NBFC is required to include all that matters and submit a report to Board of Directors. And also RBI directions have told that on exceptional basis, on what basis? On exceptional basis, even you are required to report to the RBI also. not everything. They have given a few things, or if I put it in a simple manner now itself, whatever matters which are reported to board of directors, there is a list of matters which are required to be reported to board of directors. In those matters, if you have any unfavorable comments, adverse comments, negative comments, only those points you are required to report it to the RBI. There are a list of matters which you are required to report to board of directors. So there are many matters which you are required to comment on it. So against those matters, if you have any negative remarks or adverse remarks, so that things on exceptional basis, you are required to report those matters to RBI. Able to understand? So that is what briefly, if I have to give the structure, what they talk about it in this duties of an auditor. So let us try to read it. So once again, here no concept and all there, list of points are there, we have to read it and finish it, nothing else we are supposed to do here. So let us have a look at it. So the following are the important points of an auditor, important duties of an auditor of NBFC. Number 1, compliance with NBFC auditors report RBI guidelines. So as I've told, RBI has given clear guidelines for NBFC auditors report, how the NBFC auditor should give the report. For that they have given some directions. So that directions you have to comply with. Now what does that direction say? So RBI has imposed a very onerous task of reporting to board of directors on specified matters and also to RBI on an exceptional basis. As I've told, there are list of matters which are required to board of directors and on exceptional basis. That means in case of unfavorable comments, negative comments, those on exceptional basis you are required to report to the board of directors. Then this reporting requirement is in addition to the normal reporting requirements under 143. Now these are the matters which are in addition to the reporting requirements under 143. Like 143 subsection 1 we have, which is talking about 6 matters which are required to be reported. Then we have 143 subsection 3, we have 9 plus 6, 15 matters which are required to be reported. 143 subsection 11, will CARO become applicable for NBFC? Yes, CARO will become applicable for NBFC. For banking company only exemption is there. Then even we are required to report under 143 subsection 12, fraud reporting requirements also we have to comply with. So in addition to complying with this requirements under section 143, we also need to comply, we also need to report some matters to board of directors, and also we need to report on exceptional basis to RBI. Next, as per section 45MA of the RBI Act, auditor of NBFC or non-banking miscellaneous company which accepted public deposits has to inquire whether or not the company has furnished to RBI statements information of particulars relating to deposits as required under chapter 3B. Nothing but NBFCs which are accepting deposits, they are required to submit some returns to whom? To the RBI. Whether the company has submitted that returns or not, that you are required to check once again. Companies, the management of the NBFC, they are required to submit some reports regarding the acceptance of deposits to RBI. Whether they have submitted or not, that I have to check as an auditor. Next, it also states that if an inquiry if auditor is not satisfied about compliance by the company, it is his duty to make to RBI giving the aggregate amount of deposits held by the company. They are referring to the previous point. So NBFC is having a requirement to submit a report regarding the deposits. If you find that the company has not done it, it is your responsibility as an auditor to report to the RBI what is the total aggregate amount of the deposit which this NBFC is accepting. Next, the auditor is required to incorporate report or intended to be made to RBI in his report to the company under section 143. Even in your normal report also, whatever you give, whatever matters that you want to report to the RBI, those matters you include it in your normal audit report also. Let the shareholders also know about it. Now what are those matters, sir, which are required to be reported to board of directors? So that is what this part is going to talk about. Report to board of directors under RBI directions as per master direction RBI directions 2024. So in the 2024 they have given this directions where auditor of NBFC is required to report to the board of directors on various matters. Let us see what are they. Number 1, RBI has issued NBFC auditors report directions 2016 to auditor of every NBFC. Directors shall apply to every auditor. These directions should apply to every auditor of NBFC as defined under 45 IV of the Reserve Bank of India. It will be applicable for every auditor. So auditor to submit additional report to board of directors. Once again, repeated point. In addition to your normal audit report, you are required to submit a report to board of directors on various matters. Now comes the main point. Sir, what are the material or what are the contents which I am required to include in my report to board of directors? So let us see what they are trying to say here. Auditor's report on account of a NBFC shall include the statement on the following matters. The below matters you are required to include in your report to the board of directors. Number 1, in case of all NBFCs, for all NBFCs there are certain matters you have to include. Number 1, certificate of registration. As we all are aware, any company cannot carry out non-banking financial activities in India unless they get a certificate of registration from RBI. So that's what you need to comment, whether conducting non-banking financial activity without a valid certificate of registration granted by RBI is an offense as per RBI Act. Therefore, if the company is engaged in business of non-banking financial institution and meeting its principal business criteria, what is that principal business criteria? More than 50% of the assets should be financial assets. More than 50% of the gross income should be income from financial assets. So whichever is fulfilling that criteria, they have to compulsorily get the certificate of registration. If they are not getting it done, then it will be a clear offense there. Then number 2, NBFC is entitled to hold COR. That means you have got a certificate of registration, but are you eligible to hold it? Sometimes what will happen is NBFCs will get the certificate of registration. After that, they stop complying with the conditions or they do some non-compliances, because of which they are no longer eligible to hold the certificate of registration. So you need to check, once that NBFC has got the certificate of registration, are they eligible to hold it on a continuous basis? So that we need to check it. Next, compliance with net owned funds requirements. This we already know. So every NBFC, the basic conditions, net owned fund requirements, for some it is 2, for some it is 10, for some it is even higher figures. So we need to check whether they have complied with that net owned funds requirements or not. Next, and there are also some note points here. Every NBFC shall submit a certificate from its statutory auditor that it is engaged in business of non-banking financial institution, requiring it to hold certificate of practice of RBI, and it is eligible to hold it. So as per rules and regulations, who is required to submit a report? NBFC. From whom they have to get the report? From their statutory auditors. Regarding what? That they are carrying out non-banking financial activity with a valid certificate of registration and they are eligible to hold it. Who should submit that information? The management of NBFC. And who has to give that certificate? Auditors. From their statutory auditors, they have to get it compulsorily. And this certificate, within what time you have to submit this information, sir? They say here, this certificate referencing position of the company as at 31st of March will be generally submitted to Regional Office of Department of Non-Banking Supervision, under whose jurisdiction you are registered. So to the office where you are registered, to that concerned regulatory authority you will submit it. But within what time, sir? Within 5 working days from the signing of auditor's report. Within 5 working days of normal audit report, auditor will sign, no? So from that date of signing the audit report, within 5 days up to a maximum, but not later than December 31st of the same year. Like say for example, 24-25 financial year. Now for this financial year, the company is holding, having valid certificate of registration, and whether they are eligible to comply or not, whether they are eligible to hold it or not, and management of this NBFC is required to submit one report. To whom? To the RBI. Sir, within what date? So now what they say here is, say for example 31st of March 2025 balance sheet date. Now for this year, auditor will do the audit and sign the audit report. No, say auditor is signing the audit report on 15th of May 2025. So they told that initially within 5 days from the date of report, from the date of this auditor's report, the management is required to submit that report to the RBI. Or maximum they have given a time extension of till 31st of December of that year, which means what? Till 31st of December 2025 also you have the time limit. Maximum time limit is that. Sometimes what will happen is, say for example, you are signing your audit report on 27th of December 2025. 27th of December 2025, you are signing the main audit report. Now you tell me, they say within 5 days here. 5 days will fall on 28, 29, 30, 31, 1st of January 2026 or 31st of December 2025, whichever is earlier. Which one is earlier? 31st of December is earlier. Within that date they are required to submit it. So basically whichever is earlier, within 5 working days or December 31st. Next, let us have a look at this next point. In the case of a NBFC accepting or holding public deposits. Now particularly if you are conducting audit of such an NBFC which is holding or accepting public deposits, then in your report to Board of Directors, you are required to include certain items. Sir, what I have to include? Number 1, apart from matters in A above, that means whatever we have seen, above points are all for every NBFC. These are all general points. A point is for every NBFC. This you have to report. Now when it comes to B point, this is specifically talking about in case of NBFCs accepting or holding public deposits. That means in addition to the above general matters, you are required to include the below mentioned items. As we all are aware, whenever NBFC is accepting public deposits, it is taking more risk there. Common people are involved there. There are various matters you are required to check and report. So what are they? Let us see. So apart from matters in A above, the auditor shall include a statement on the following matters. On what? On the public deposits accepted together with other borrowings. So what is the total amount of public deposits and other borrowings that you have accepted? From whom? From the public, from its shareholders, or from other entities, whoever it is. So which are not excluded from the definition of public deposits. That means from whom you are eligible for. There will be certain people from whom you will be eligible to take the public deposits. So from whom you have taken that public deposits or other borrowings. From public, how much you have taken, from its shareholders, if you have taken that, how much, or apart from public or shareholders, from other entities like financial institutions, which are not excluded. That means from which you are permitted to take the things. So you have to mention in your report. Next. And also we need to check whether they are within the admissible limits as per the provisions of NBFC acceptance of public deposits rules. How much deposit NBFC can accept, for that they have given guidelines. We need to also check that from all these people, whatever deposits or borrowings they have accepted, is that within the limits. Number 2, whether public deposits held by the company in excess of the quantum of such deposits permissible under the provisions of these directions are regularized. In case because of any reason they have got the excess borrowing or deposits than permissible, that should be regularized. What do you mean by regularized? The company has to bring it within the limits once again by giving back the deposits or borrowings. So we need to check that regularization. Number 3, whether NBFC is accepting public deposit without a minimum investment grade credit rating from an approved credit rating agency. So this is also, as we have seen, how much deposits you can accept, that will be linked with your credit rating. Like as I was telling yesterday. So if you are A plus, they might say 5 times of net owned funds. So if you are B plus, you might be eligible for only 1 time of net owned funds. So there will be certain minimum investment grade criteria. Say for example, as per RBI regulations, you should have minimum B plus rating. So check whether your client NBFC is having that minimum grading. So, and also check even without that minimum grading, are they accepting the deposits? That also you have to check it. So if they are accepting deposits, they should have a minimum grade of minimum credit rating got from a appropriate agency like CIBIL, CRISIL. From these people, they have to get the credit rating. Next, whether capital adequacy ratio as disclosed in the return submitted by the bank in terms of master directions has been correctly determined, and whether such ratio is in compliance with minimum CRAR. So we have already seen what is that minimum CRAR ratio, capital adequacy ratio. So bank is required to submit to the RBI. NBFC is required to submit to the RBI. Sir, we have this much amount of tier 1 capital, this much amount of tier 2 capital. This is our risk weighted assets. Our capital adequacy ratio is this much percentage. This information who will submit? NBFC will submit to the RBI. Now what they are asking you to check, verify whether all that calculations submitted to the RBI are correct or not. Next. In respect of NBFCs referred to in clause 3 above, which means here whether you have got the minimum credit rating or not. In respect of those NBFCs, whether credit rating for each of the fixed deposit scheme that has been assigned by one of credit rating agencies is in force. If you don't have a minimum credit rating agency for the entire NBFC as a whole, for products whatever they are offering, like for example they offer fixed deposit schemes and all, for the purpose of accepting deposits. As we all are aware, NBFCs cannot accept demand deposits. They can only accept term deposits. So there will be different kinds of products. For each product, at least they have a credit rating or not. You have to get it. Like for bonds also you will have credit rating. For shares you will have a kind of credit rating. So you need to check whether for each fixed deposit scheme they have obtained the different credit ratings. And whether aggregate amount of deposits outstanding at any point of the time during the year has exceeded the limit specified by such credit rating agency. Even we need to check whether they have accepted beyond the limit which is permissible. Next, whether the company has violated any restrictions on acceptance on public deposits as provided in some directions. So they have given some directions, in that they have told certain conditions, whether those conditions are complied with or not, we need to check. Whether company has defaulted in paying to its depositors the interest and or principal amount of deposits after they have become due. Have they made any default in the repayment of principal and payment of interest? Then, whether company has complied with prudential norms on income recognition, accounting standards, asset classification, provisioning, and concentration of credit investments as specified in the directions. Nothing but every prudential norm has been complied with or not. That also you have to comment on it. whether the company has complied with liquid assets requirement as prescribed by the bank in excess of its powers with RBI. Basically, as I've told, like banks, NBFCs are also required to maintain a kind of SLR ratio. So whether they are maintaining that minimum percentage of money in that liquid assets, if yes, with which bank they are holding that assets, that we need to verify and give a comment. And whether the company has furnished to RBI within stipulated period return on deposits as specified in DNBS 01. NBFCs are required to submit a form with their RBI in form DNBS 01. To whom? To RBI. As an auditor, I need to check whether they have submitted that DNBS 01 or not. They are not asking auditor to submit that DNBS 01 form. They are only asking auditor to check whether management of the company has filed that DNBS 01 form with the RBI or not. Next, whether the company has furnished to RBI within stipulated period the quarterly return on prudential norms. Not just DNBS 01, even the banks are required to submit quarterly return on prudential norms. Here also they are not asking auditor to send a report on prudential norms. They are only asking you to check whether management has submitted that quarterly return to the RBI on prudential norms or not. Next, whether in case of opening of new branches or offices to collect deposits, or if there is a closure of existing branches or offices or appointment of agents, company has complied with the requirements in NBFC acceptance of deposits. Either if they are opening a new branch or closing an existing branch. For that also there are directions, you need to check that directions. So these are the specific matters which you are required to report in the case of NBFCs which are accepting public deposits. Now, what will be the reporting requirements to the board of directors in case if I am conducting audit of NBFC which is not accepting public deposits? See, A point will be common. A is applicable for all NBFCs. B point we have seen only for those NBFCs which are accepting public deposits. Now they say if you are conducting audit of an NBFC which is not accepting public deposits, here specifically what you need to comment. Apart from the aspects in A above, auditor should include a statement on the following matters. Which matters? Number 1, whether board of directors have passed a resolution for non-acceptance of any public deposits. So every NBFC which is non-deposit taking, they need to pass a board resolution that they will not accept any kind of deposits. Then whether company has accepted any public deposits, they should not have done it. Check whether they have done in violation. Then whether company has complied with the prudential norms relating to income recognition, accounting standard, blah blah blah. So whether prudential norms have been complied with or not. Then whether capital adequacy ratio as disclosed in return submitted to RBI in form NBS 7 has been correctly arrived. So once again, management will submit their report to the RBI whether they have complied with the capital adequacy ratio or not. You also check it once whether that information calculations are correct or not. Whether company has furnished to RBI annual statement of capital funds in NBS 7. Same, these 2 points are common, whatever we have seen above. Whether NBFC has been correctly classified as NBFC microfinance institution as defined in some directions. So in case if you have been classified as microfinance institution, whether that classification is proper or not, we need to check it. So as you could see here, very limited points are there if you are conducting audit of an NBFC which is not accepting public deposits. But if you are conducting audit of an NBFC accepting public deposits, there is a very lengthy list there. Next. In case of a company engaged in the business of non-banking financial institution which is not required to hold certificate of registration subject to certain conditions. Like if you remember, one heading we have seen, even though you are carrying out the non-banking financial business, there are some companies which are exempted from registration with the RBI. One example also, if I have to give CIC, if you fulfill certain criteria, you are not required to get registered yourself with the RBI. So like that, if your client is an NBFC, but still it is exempted from taking registration because they have complied with some conditions. Now I need to check whether they continue to comply with that condition or not. Whether they have really complied with the conditions in order to make them exempted from registration, that compliance with the conditions I have to check it. So that's what they say here. Here also common, apart from matters mentioned in A1 above, where a company has obtained a specific advice from the RBI that it is not required to hold certificate of registration. Auditor shall include a statement that company is complying with that conditions. If RBI has told you are not required to get yourself registered if you comply with certain conditions. So I need to check whether the company is in continuous compliance with the conditions or not. So this is what regarding point number D. So then coming to fourth one. Sir, I will report all the above matters and RBI guidelines say that if you have any unfavorable comments, negative comments you are giving. Say for example, NBFC did not submit that written regarding capital adequacy ratios, or they have included wrong information in that written on minimum capital adequacy ratio. For that, you have to give a negative comment or not? Yes, you have to give a negative comment, and you should also state the reasons why you are giving that negative comment, why you are giving that unfavorable comment. For that, you are also supposed to state what reasons. Similarly, if you are unable to comment on any of the points which we have discussed up, there are some matters which are required to be reported. If you are unable to comment on any of the points specified above, for that also you have to say the reasons why you are unable to comment on any of the points above. So if you are giving negative comments, give the reasons. If you are unable to give the comments, if you are unable to give the opinion on any of the point, for that also you have to give reasons why you are unable to comment on that. So that's what they say. Where in auditor's report, statement regarding any of the items related to in para 3 above is unfavorable or qualified, auditor's report shall also state reasons for the same. When auditor is unable to express any opinion on any of the items referred to in para 3 above, his report shall indicate such fact together with reasons. If you are unable to comment on it, so say the same thing, I am unable to comment on so and so point, and in addition to that also mention reasons. Then obligation of auditor to submit an exception report to the RBI. Above points are all you are submitting to board of directors. Now you are also required to submit one report to the RBI on exceptional basis. What do you mean by on exceptional basis? From all the above points, wherever I have given unfavorable comment, those points I have to separate it, and that matters I have to include in a separate report. That report I have to send it to RBI. So this is what they say here. Where in the case of NBFC, statement regarding any of the items referred to in para 3 above is unfavorable or qualified, or is in the opinion of auditor, company has not complied with provisions of chapter B, or they have not complied with RBI's NBFC public acceptance deposit directions, or they have not complied with directions of NBFC scale based regulations. You need not remember it, just remember if you have found any negative comments, or if you find that the bank NBFC did not comply with the guidelines or regulations of NBFC Act or this RBI Act. So then what you should do, it shall be the obligation of auditor to make a report containing details of such unfavorable or qualified statements or that non-compliances as the case may be in respect of the company to concerned regional office of Department of NBFC of RBI under whose jurisdiction you are registered as per the first schedule to the NBFC deposit rules. Clear everyone? So if you find any negative comments or if you find any non-compliances, these matters you are required to report it to RBI on exceptional basis. Yeah, additional. So these are some extra directions. So that directions also, if there is any non-compliance, you are required to report it. Next. The duty of the auditor under subpara 1 above, that means this is a duty of the auditor to report these matters to the RBI. Shall be only to report in only contraventions and directions, guidelines, instructions referred to in para 1 of such report, but shall not contain any statement with respect to compliance. Which means only if you are non-complying, you report it. If they are complying, don't mention once again that they have complied with so and so law and regulations. So that's what they're reporting on exceptional basis. So only when you have negative comments, only when you find non-compliances, then only you report it. If everything is okay, if everything has been complied with, no need to separately state once again that all the things are complied with. You need not separately state them. Understood? So this is what the auditor's reporting responsibilities. But the reporting responsibilities are not done with. Even as I've told, in CARO also you are required to report. CARO reporting requirements also will become specifically applicable, and specifically when we talk from the NBFC's perspective, what points will become applicable is, anyhow we have a dedicated clause, no? Clause number 16, which is exclusively talking about what matters you are required to report in case if you are conducting audit of NBFC. So what does that clause 16 say? So here, as you could see, whether a company is registered under is registered under 45 IA, if yes, if it is required, if the registration is obtained or not. Whether the company has conducted any non-banking financial or housing finance activities without obtaining a certificate of registration, or if the company is a CIC. So we need to check whether they comply with the conditions, or if it is an exempted or unregistered CIC, whether they comply with additional conditions. As a part of the group, is there one CIC or more than one CIC? If there is more than one CIC, indicate the number of CICs as a part of the group. So this we have almost one dedicated clause number 16 talking about NBFC. In addition to that, since NBFCs also will be in the business of taking loans or giving loans, the main business, as I have told, giving of the loans. Majority of the NBFCs are into business of giving of loans and advances. So there are some points exclusively reserved for loans and advances also in the CARO. Like if you see third point, loans, advances, deposits, which are investments which are made by the company to the others. So under that clause number 3 also I am required to report. And if you remember, under clause number 3, they will say 6 points. Open CARO. Come on, do it. Open CARO. We'll do the comparative study and close it. Open the CARO clause number 3. Right. So what is there in clause 3? What does the clause 3 talk about? Clause 3 is talking about to report on some loans, advances which are made by the company, which are given by the company. So even NBFC is also in the business of giving that loans and advances only, no? Right. So in that cases, regarding loans and advances given by the company, there are 6 matters which are required to be reported. So number 1, what they will ask you to do? You need to bifurcate. In case if the company has given the loans, you need to bifurcate what is the amount of loan given and balance outstanding for subsidiary, associate, joint venture, for other than subsidiary, associate, joint venture. But you see in the bracket there, we will say this point is not applicable for those companies whose principal business is giving loans. Yes or no? Able to find it? That means this point under this clause is not applicable for NBFC. This matter you are not required to report. First point. Second one, what is the second point there? Whether the terms and conditions are they prejudicial to the interest of the company or members. This point we have to include or not? Yes. Number 2, the third point, what you will find it there? Whether the loans are repayable on, whether there is a proper schedule of repayment and whether the payments are received regularly or not. This matter also we have to include it. Then fourth point, whether any amount is overdue for more than 90 days. If yes, whether reasonable steps have been taken for recovery. Fifth point, whether any loan has fallen due in the current year, but instead of collecting it, either they have renewed, extended, or fresh loan has been given. But there also, if you see in that point also, not applicable for those companies whose principal business is to give loans. Is it there? Yes. That means will this point come for NBFC? No. This point also will not come. So if you come to the last point, what is the last point? Whether the company has given any demand loans or call loans. If yes, what is the amount given? Percentage and amounts given to promoters and directors. Should this point come? Yes. Why? Because there we did not say it in the CARO they did not say this point will not become applicable for those companies whose principal business is to give loans. They did not say that. So that's why this point also should come under NBFC. So under specifically clause 3, out of 6 points, only 4 points under clause 3 are required to be reported. What are they? Number 1, whether the terms and conditions are prejudicial. Number 2, schedule of repayment has been drafted and payments are regular. Number 3, whether any amount is overdue for more than 90 days. If yes, what steps are taken by the management for recovery. And the last point, whether any demand loans are given. If yes, the total amount of the demand loans, percentage, and how much amount has been given for the board of directors or promoters or related parties that we have to report it. That's all. This is what the 2 points they say here when it comes to CARO. Okay, so come back to the NBFC chapter again. Right, so that also we had done. Now let us talk about Ind AS. We told that Ind AS applicability has been deferred for banks. Then what about NBFCs? For NBFCs, they have to comply with the Ind AS. NBFCs have to comply with Ind AS. There is no exception for them. They have to comply with the Ind AS. So applicability of Ind AS on NBFCs. NBFCs are required to comply with Ind AS as per Rule 4, Sub Rule 1, Clause 4 of Companies Ind AS Rules 2015 and as amended by Companies Ind AS Amendment Rules. So every NBFC is also required to comply with Ind AS while preparing the financial statements. Next, format for preparation of financial statements by NBFCs under Ind AS. So MCA, they have released a notification. Under that notification, they have in the schedule 3 only, we have something called Division 3. Division 2 talks about other than NBFC. In the schedule 3, we have divisions. Division 2 will talk about preparation of financial statements of other than NBFC. For normal companies, how to prepare the financial statements and all, that is given under Division 2. In the schedule 3, they have given something called Division 3. That Division 3 will talk about how to prepare the financial statements of an NBFC. So if you want to look at the detailed format of financial statements of NBFC, I have given the QR code there. Just scan it. It will be a file will get opened there. So just an illustrative format will be there. So just have a look at it. not that important. No one will ask you to prepare the financial statements of NBFC in audit, but just if you want to have a look, that you can have a look at it. Scan the QR code, just you will get the illustrative format of the balance sheet. You will get balance sheet, P&L, everything you will get. Sir, you have told in schedule 3 two divisions are there. So what are the two divisions I have told? Division 2, it talks about financial statements relating to other than NBFCs. Whereas we have division 3 of schedule 3, which is talking about how to prepare the financial statements of NBFCs. Sir, what are the key differences between the two? How does the division 2 of schedule 3 differ from division 3 of schedule 3? So what differences they have provided? So let us try to understand what are the differences between them. So if you see here, presentation requirements under division 3 for NBFCs are in most aspects they are similar to division 2 of non-NBFCs to a larger extent, except a few differences are there. So what are the differences is, number one, NBFCs have been allowed to present items of balance sheet in the order of their liquidity, which is not allowed to companies required to follow division 2. For normal companies, we present how assets in what manner? Non-current assets, current assets we do. But for NBFCs, they have given an option. You can disclose your assets in the order of your liquidity. That means the most liquid assets will come at top, the less liquid assets will come at the bottom. You tell me cash, where it will come? At the top. Why? Because it is the most liquid asset. That option has been given for whom? In the division 3 NBFCs, they have given the option. For companies, they have not given the option. You have to follow that non-current, current, that order you have to follow. Next, an NBFC is required to separately disclose by way of a note any item of other income or other expenditure which exceeds 1% of the total income. So you have to separately disclose any income or expenditure which exceeds 1% of income. Who? NBFC. Whereas when it comes to division 2, they say that it required disclosure of any item or expenditure which exceeds 1% of revenue from operation or 10 lakhs, whichever is higher. So for normal companies, they told disclose the income of expenditure or income or expenditure separately when it is exceeded either 1% of revenue or 10 lakh rupees, whichever is higher. But for NBFCs, what they have told? Only that 1% condition has been given, that 10 lakhs was not given there. Next, NBFCs are required to separately disclose under receivables debts due from any LLP in which its director is a partner or member. This is one extra matter which they have given in under division 3. So when you are preparing the financial statements of NBFCs, when you are giving the balance sheet, in the receivables heading, you have to separately give a breakup. That means for the receivables, you have to give a breakup. In that breakup, you have to include what are the debts due from any LLP in which the director of NBFC is also a promoter or member. That you have to disclose separately. It is a related party. Specifically, they have added this, but this explicit requirement is not there under division 2. Next, NBFCs are also required to disclose items comprising revenue from operations and other comprehensive income on the face of statement of the P&L only, whereas instead of showing only as part of notes. That means they can what items will come under revenue from operations? Interest income, dividend income. So generally what normal companies will do, revenue from operations they will get the total figure, note number will be there. If you go to the note number, there you will get the breakup. Same for other comprehensive income. But what they are telling, NBFCs, what they are supposed to do? They should not disclose that breakup of that revenue from operations in the notes. Do it on the face of P&L only. So write revenue from operations on the face of the P&L itself. Below that you add what are the different kinds of revenue from operations. Are you having leasing income? How much is from higher financing, higher purchase income? How much is interest? How much is dividends? So that you have to disclose it on the face of the P&L, not in the notes. Who? NBFCs. Next, separate disclosure of trade receivables which have significant increase in credit risk and credit impaired. This is also for NBFCs. They need to separately disclose those trade receivables which have a high credit risk and also whose credit is impaired, whose credit is in danger. And the conditions or restrictions for distribution attached to statutory reserves have to be separately disclosed in the notes as stipulated by relevant statute. So one more condition here, what they have told is if NBFC is holding any statutory reserves, how they are supposed to use it, for what purposes they have to use it, they have to compulsorily disclose in their notes to accounts, which explicit requirement is not there for other companies. Understood? So these are the main differences between Division 2 of Schedule 3, which is talking about financial statements of other than NBFC, and Division 3 of Schedule 3, which is talking about financial statements of NBFCs. So tell me, what are the few differences? Number one, NBFCs are permitted to disclose their assets on the basis of their liquidity. And in case of Division 2, they have told, in case of Division 3, they have told, include any income or expenditure which exceeds 1% of total income. But other companies, what they have told is income or expenditure which exceeds 1% of the total revenue, or 10 lakhs, whichever is higher. That 10 lakh reference is not there for NBFCs. Then coming to the third one, especially NBFCs, under their receivables, they have to show separately debts which are recoverable from LLP in which their director is a partner or member. And then comes the next one, NBFCs on the face of the P&L, on the statement of face of the P&L itself, you are required to give the breakup of revenue from operations and other comprehensive income. And you need to do a separate disclosure of trade receivables which have a significant increase in credit risk and credit impairment, and also the conditions or distribution, the conditions or restrictions regarding the distribution of statutory reserves is also separately required to be disclosed as per the requirements of the relevant law or regulation. Understood? That's all. This is what regarding the audit of NBFCs. Now let us have a look at the questions. We will not have any such new questions. All pretty much straightforward questions we will have, and whatever is complicated, that we have already done, like determining net owned funds, determining whether principal business criteria is met or not, determining that capital adequacy ratios, determining that provisioning. These are the complicated. If there is anything from complicated from this NBFC chapter, these are the complicated that we have already done. Remaining all the questions are very straightforward and easy questions. Let us try to do them once quickly. Right, so let us have a look at it. Page number 236. So test your understanding. Question number 1. FinCrazy is a P2P online platform. NBFC P2P, peer-to-peer, falls under base layer. So FinCrazy is a P2P online platform owned by Future Technologies Private Limited, which is registered with RBI as an NBFC. Peer-to-peer platform means an intermediary providing the services of loan facilitation via online medium or otherwise to the participants. As I've told, P2P doesn't give any direct funding. They are just a mediatory. Then participants have to enter into an arrangement with NBFC P2P to lend on its platform or avail loan facilitation services provided by it. It provides only as a medium connecting lenders and borrowers. It also carries out the credit assessment and risk profiling of the participants on the platform. They will analyze that credit rating, credit appraisals also they will do. It also provides services relating to loan documentation and loan recovery. The company falls outside of the purview of upper layer. Why? Because we all know P2P will always go to base layer. Where does such NBFC fit in accordance with the scale-based regulations? Suggest a few audit procedures. So where it will go, guys? It will go into base layer. Now what they're asking you, few audit procedures which you will perform. Like once again, overall a brief they have given. We have discussed a detailed checklist there. We have discussed detailed responsibility, but out of that a few points they have picked up and added it here. Like we will check, we will try to understand the business of the P2P by reading its MOA, AOA and all. Number 2, we verify whether they have obtained the certificate of registration or not. Whether they have a board approved policy setting out the eligibility criteria for participants. That means who can do the transactions through them, whether they have a written format or not. Verify board approved policy for pricing of services. You need to check what policies are there with regard to the pricing for their services. Verification of adherence to lending and borrowing guidelines. Once again, guidelines, regulations are all complied with or not. Verifying appropriate arrangements have been entered into among participants. With the customers and with the lenders, they have entered into proper agreements or not. Compliance with reporting requirements of RBI, which we have just now completed. All that reporting requirements you have to comply. And verifying board approved policy for grievance, addressal and complaints. If at all they get any complaints from their customers, how they have to approve, how they have to address it, how they have to resolve it. For that also there is a policy from the board of directors or not, we need to check. Some general points they have told. Next, Sugam Housing Finance Limited is in the business of housing finance activities and they have an asset size of 800 crores. Its principal business is of providing finances for housing mainly to individuals. It is not identified by RBI in the upper layer. Under scale-based regulations introduced by RBI, what should be appropriate classification? Company engaged in the business of housing finance activities. It should fall under which layer? Check the layers. In the middle layer specifically you will find it. So here they will find housing finance businesses. So those companies which are doing housing finance activities, it will go to middle layer. Anyhow, they have clearly told that RBI did not keep them in the upper layer. So upper layer there is no criteria. RBI will pick and keep it there. So if it is not in the upper layer, it will definitely not be in the top layer also. That means it will not be a even high risky thing also. So it has to definitely go to the middle layer. So is there any specific requirement under CARO for statutory auditors of a company engaged in housing finance activities? That clause 16 will come, no, whether the company has obtained valid certificate of registration, whether the client is doing a non-banking financial or housing finance activities without obtaining a certificate of registration from RBI. Nothing but clause 16. Housing finance activity is also a NBFC. So for NBFCs, which clause we have? Clause 16 we have. So that matter you have to report it here. Yes. 1,000 crores. But they did not say anywhere whether it is a deposit taking, non-deposit taking. They did not say, no. Housing finance business, we see business whatever they have given, that business wise they have to compulsorily go to that layer only. Specific names they have told, no. P2P always it has to go to base layer. Housing finance it should always go to base. Housing finance it should always go to middle layer. And non-operative finance holding company, that should always go to base layer. So like that, whatever specific names they have given, that will specifically go to that layers only. Next. You can consider it as exclusive. Next. You are auditor of a deposit taking NBFC. So deposit taking NBFC, where it will fall? If the NBFC is taking deposit, where it should go? Middle layer directly it should go. Unless RBI keeps it in a upper layer or top layer, it will remain under middle layer. The NBFCs identify the RBI in its upper layer. So what they are telling? Because of some risky factors, RBI has moved it from middle layer to upper layer. And its financial statements are required to be prepared in accordance with the requirements of Ind AS. The following is an extract of profit and loss for the year ending 31st of March 2024 in accordance with the Division 3 of Schedule 3 of the Companies Act. Previous year figures are ignored. See, this is just a test your understanding. This is not any question. They have given on one test your understanding boxes will be there. There they have given format, just a presentation example they have given. So that we have included a kind of illustration you can take. You can take it. It is not a question. So example of disclosure they are giving. So an NBFC is preparing financial statements in accordance with the requirements of Division 3 of Schedule 3 of the Companies Act. They have to separately disclose any item of expenditure which exceeds 1% of total income. Or I think the question is missing here. So relevant extract is missing here. So that I will try to update it. Okay. So just the logic is there will be some expenditure. If it has exceeded 1% of the total income, that you have to disclose it separately in the notes to accounts. So that regarding that condition, one extract might be missing here. So I will try to add it. Okay. So I will try to bring it before you. No worries. Next one. Now coming to the test your knowledge questions. Define NBFC. Also give a brief description. Types of NBFCs covering any 5 NBFCs. Can you do that? Defining its registration requirements, various types of NBFCs. So we all can do that, right? Right. So direct theory question. Shubham and Associates are going to start the audit of NBFCs. They have not performed much work for the NBFCs in the past years. You are required to explain the requirements relating to registration, regulation of NBFC, which an auditor need to keep in mind while performing audit. Registration and regulations. Second heading only you will be able to find it. Next. Satyam Private Limited is a company engaged in trading activities. It also has made investments in the shares of other companies and advanced loans to group companies amounting to more than 50% of its total assets. Financial assets are more than 50%. However, trading income constitutes majority of its total income. Whether the company is an NBFC? No. 2 conditions they are required to fulfill. One is their financial assets should be more than 50%. Their income from financial assets also should be more than 50% of the gross income. Here they might have financial assets more than 50%, but what they have told clearly that trading income is the majority portion, not the income from financial assets. So you often get confused. Trading, you might be thinking of trading of shares. No, they're talking about normal trading business like goods and services trading business. So there what is happening is only financial assets criteria has been fulfilled. Income from financial assets criteria is not fulfilled. So it need not be classified as NBFC. Next one. Shivam & Co LLP are the auditors of NBFC. Some of the team members of the audit team who audited this NBFC have left the firm, and new team members are in discussion with the previous team members who are still continuing with the firm regarding the verification procedures to be followed. In the context, please explain what verification procedures are required to be performed in relation to audit of NBFC investment credit company. See, they will try to confuse you whether it is an investment credit company or not. Some common audit procedures we have, no. Some common verification things we have, no. Some checklist we have, no. So from that few points you have to pick it up. Now people often fall into trouble here. In our material there is no such question how to conduct audit of core investment company. We will not find any question how to conduct audit of a core investment company. Nowhere you will be able to find it. So you might think it is something out of the context. No. So this is one way of testing. They are using specific name, but there is no question. But that is a category of NBFC. So can't you write some general verification procedures? Yes, that you have to do it. Next. You are appointed as a statutory auditor of NBFC registered with the RBI and which is accepting and holding public deposits. Which layer? Middle layer. You are considering your reporting requirements in addition to your report made under section 143 of the Companies Act on account of this NBFC as per the proposed directions. Please explain what points you are required to be known in respect of the separate report to be given to Board of Directors. Reporting requirements we have seen, no? And they are also para B. They are specifically talking about those NBFCs which are accepting public deposits. Right. So that you need to write those points. Next. Kamna & Co LLP, a firm of chartered accountants, was appointed as auditor of NBFC. The audit work has been completed. The audit team, which was involved in the field work, came across various observations during the course of audit of this NBFC and have also limited understanding about the exceptions which are required to be reported in the audit report. They would like to understand in detail regarding the obligations on the part of the auditor in respect of exceptions in his report so that they can conclude their work. See, on an exceptional basis, you are required to submit a report to the RBI or not. So what are that exceptions which you are required to report? So I have told that the three kinds of acts non-compliances and all that unfavorable comments. That is what the exceptional transactions which you are required to report to RBI. So you have to give only negative comments there. You can't say about any compliances. That point also I have told you, no. So you have to comment only on non-compliances. You should not comment on any kind of compliances. Next. The statutory auditor of the NBFC is required to give a report to the Board of Directors. What should be the contents of the auditor's report to the board? Very broader question. They did not say whether it is deposit taking, non-deposit taking. So you might be required to write here all the reporting requirements, paragraph A, B, everything you have to write. But don't worry, this question they will not ask in the examination. It is unfit for the exam. Why? Because these many points you can't expect for 5 or 4 marks. But what they will specifically do is one particular paragraph they will pick. Like either they might ask about reporting requirements of only public deposit accepting company, or they might ask you only reporting requirements of non-public accepting company, or they might ask you what are the exceptional reporting to RBI. So like that part will be tested. They will not ask you a broader question. Next. Krishna Private Limited is primarily into the business of selling computer parts. However, the company is fulfilling the principal business criteria as at the balance sheet date. That is, financial assets are more than 50% of its total assets and financial income is more than 50% of its gross income. What should be the obligation for the statutory auditor? So they need to check whether they have obtained the certificate of registration from the RBI or not, because they are fulfilling the criteria of NBFC. Next. So Mr. G has been appointed as a auditor of LMP Limited, an NBFC company registered with RBI. Mr. G is concerned about whether the format of the financial statements prepared by LMP Limited is as per the notification issued by MCA dated October 11, 2018. The notification prescribes the format in Division 3, which is applicable to NBFCs along with Ind AS. Mr. G wants to know the difference in the presentation requirements between Division 2 and Division 3. That is the last paragraph which we have understood. Next. Abhimanyu Finance Limited is a non-banking finance company and it was in the business of accepting public deposits and giving loans. It is accepting the deposits. And the company has net owned funds of 1.5 crores. That much only? Okay. Net owned funds of 1 crore 50 lakhs. And was not having registration certificate from RBI and applied for it on 30th of March 2024. The company appointed Mr. Kabra as its statutory auditor for the year 2023-24, advised the auditor with reference to audit procedures to be taken and reporting requirements on the same in view of CARO. First thing, they need to have net owned funds criteria. They need to get the registration. So now you will comment negatively in your CARO or not? Why? Because Caro says even before you commence the operation, you have to get the certificate of registration. But here, what they are doing, they have commenced the operations. After that, they have submitted an application for registration from RBI. So you will comment in a negative manner for that clause 17 or not. See, they are not talking about all reporting requirements. Specifically, they have told comment on reporting requirements only as per Caro. If they ask us about detailed reporting requirements, we will write all that points we have seen as per RBI directions. What are the matters which are required to be included in the report and all. But they are not asking all reporting requirements. They are only asking what will be our responsibility when it comes to Caro 2020. So before you commence any operation, you should not carry out any non-banking financial or housing finance activities unless you get a certificate of registration from RBI. Right. Next. What is this? Yo-Yo Finance Limited is NBFC middle layer as per the revised category. So what is the question they are asking? What things you will try to perform regarding prudential norms? As an auditor, what procedures you will try to perform in prudential norm? So like if you see the audit of NBFCs, there we will have one heading, I think heading number 5. So how do you verify the prudential norms and all? So there you will get it. Next. This we have already covered. Coming to past MTPs and all, this we have covered. This is the once again differences between division 2 and division 3 of schedule 3. That we have already done it. 3, I think we have already done it. Capital adequacy ratio we have calculated, or I have given it as homework. I think this I have given it as homework, no? Yes, nothing but 50% criteria checking. Then after that, let us see. Suhana, a CA final student, is part of engagement team conducting audit of CMM Finance Limited, a listed NBFC. While going through the audit program, she notices that it contains instructions for verification of following matters, among other things in relation to disclosure requirements of Schedule 3 of the Companies Act. Verification regarding disclosure of any item of income or expenditure which exceeds 1% of revenue from operations at 10 lakhs, whichever is higher. Tell me, is it correct here? No, because she is conducting audit of NBFCs. What she should check? Only 1% of the gross income. That 10 lakhs criteria is not there. Verification of disclosure regarding return on capital employed ratio, return on equity ratio and net profit ratio. So okay, that also she wanted to verify. Discuss whether instructions for similar matters need revision. And one more thing here, coming to the second point, when she is conducting audit of NBFC, is that the ratio which she has to concentrate? Return on capital employed, return on equity, is that the ratio which she should worry? No. Which ratios she is required to be worried about? That CRAR, capital adequacy ratio. What is the tier 1 capital plus tier 2 capital divided by risk weighted assets? Is it minimum 15% or not? What is the tier 1 capital? What is the tier 2 capital? These are the ratios she is required to be concerned about, not the return on capital employed, not the return on equity. So what is that she has to worry about in the case of NBFC? That capital adequacy ratios she is required to get worried about. So these two things are there. She needs updation of instructions. So she should be worried about any item or other income or expenditure only which exceeds 1% of the total income, that is requiring separate disclosure, and disclosure of following ratios. She should not concentrate on these ratios. Which ratio she has to concentrate? Capital to risk weighted ratio, CRAR, that is what we call it as capital adequacy ratio. What is a tier 1 CRAR, tier 2 CRAR, and they also require to disclose in the case of NBFCs one more ratio called liquidity coverage ratio. So this is what she has to get worried, not written on capital employed, not written on equity. Clear? So with this we have successfully completed the NBFC chapter. Okay, right. So now we will go for the break. Once the break gets over, we will my objective today is to cover specialized areas. We have 3 standards under SA 800 series. So that specialized areas I will cover. But before doing that 800 series, there is one prerequisite. SA 720 we have to discuss, which we did not discuss it. Some standards are still pending, like some standards I have kept it out for later discussion. So that we will do. SA 720 we will try to complete out first. Auditor's responsibility regarding other information. Very small standard. 30 to 45 minutes will complete it. After that we will go to specialized areas discussion. Okay, 800 series we will try to discuss. Fine. So let us meet after the break. Okay, so here comes the next chapter, which is specialized areas. 800 series we have. Question bank, there is nothing much to discuss. You can, wherever SA 720 you find it in the answer, just read it. So if at all required, we will do it. I have looked at the questions. There is nothing which require my involvement to make you understand. So I'll directly go with the specialized areas. So let us try to understand the chapter specialized areas. So now let me set out very easy chapter, guys. Very easy chapter. Hardly a few hours we can complete the chapter. And the thing here is these standards, whatever we are going to discuss in this chapter, they have recently undergone some changes. They have recently some amendments which are made to the standards. So since it is a most relevant topic, so remaining alert is very important here. Earlier, these standards are not important. Once in a while they used to ask it. Very rarely they used to ask. But since this areas contains a few amendments in the reporting requirements, especially in these 3 standards, that's why its importance has gone up now. Okay, right. So let us try to understand what are the specialized areas, what exactly we are going to learn in the specialized areas. So from the last 2 days we are having very boring discussion, no? Now for a few days, for today, tomorrow we will have a conceptual discussion. Will not be that boring. So it will be engaging content only we will have, right? Once again, I will not tell you the chapter. I will tell you I will not come. So which chapters will be boring again? I'm supposed to tell you, but I will not say it, right? So specialized areas we are going to discuss. Sir, what are these specialized areas? Sometimes we chartered accountants in practice, we mainly do audits. And whatever audits we do, like whatever standards we have covered, till now we have covered 200 series of the standards, 300 series, 500 series, 700 series, which is talking about audit procedures and engagement letters, our reporting requirements, and how you can make use of the work of others. So like that, so much of content we have discussed from the standards. Now all the standards are talking from the perspective of audit of general purpose financial statements. All the standards are talking from the perspective of general purpose financial statements. Basically those financial statements which are prepared by the entity for various needs of various users' needs. Like financial statements prepared by the listed company, financial statements, statutory audit of a normal company. So whatever standards we have discussed now, those are all the standards which are talking from the audit perspective of a general purpose financial statements. Like what audit procedures we have seen, engagement letter, audit reporting, every standard whatever we have discussed, that is purely from the perspective of audit of general purpose financial statements. Those financial statements which are expected to fulfill the information needs of all the users. But sometimes we chartered accountants, we might also be requested by the clients to do audits of special purpose financial statements or that financial information which is specific only for certain users. Sometimes we as a chartered accountant, we might be requested by the clients to do some audit engagements where we are verifying some special kind of financial statements prepared for specific users, not for everybody's use. Some users will be there, they will have their own requirements. According to that requirements, they get the financial statements done and they will approach you as an auditor. Sir, you please verify these financial statements which are not for everybody, which is for specific users. Just a minute, I have to keep my laptop on charge. Yeah, please settle down. So as I was saying, till now, whatever standards we have discussed, those are all talking from the perspective of general purpose financial statements. But we chartered accountants, so we might be sometimes called to verify some information which is not prepared for everybody, which will be prepared for the specific users. And that special cases can be of 3 categories. That special cases where we are required to verify information for specific users, that could come in 3 circumstances. Number 1, as an auditor, sometimes we might be called upon by the client to do the audit engagement of financial statements which are prepared as per special purpose framework. The management might prepare the financial statements as per special purpose framework to fill the needs of specific user. So in case if you are called upon by the client to conduct audit of the financial statements prepared as per special purpose framework, not as per general purpose framework, there is some special purpose framework. According to that framework, financial statements are prepared and the client is calling you to do the audit of that financial statements as per special purpose framework. then how to do the audit of that, how to conduct that audit engagement. That guidance has been given under SA 800. That guidance is given under SA 800. Case number 2. Sometimes as a chartered accountant, you might be called upon by the client to do audit of not complete financial statements. They might ask you to conduct audit of a single financial statement or a particular element of a financial statement. Sometimes some clients might approach you asking you to do the audit engagement. But that audit engagement is not for audit of complete financial statements. That audit engagement is only to do the audit of a single financial statement or a particular element of a financial statement, element or item of a financial statement. Sir, what do you mean by this? Sometimes some client might approach you and say, sir, please do audit of only balance sheet. Sometimes some client might come and say, please do audit of only P&L statement. Some client might come and say, please do audit of only cash flow statement. That is a single financial statement audit. Or sometimes some clients might come up with a requirement, sir, we want you to conduct audit of only our trade receivables. We want you to conduct the audit of only revenue. We want you to conduct audit of only fixed assets. So this we call it as audit of a specific element or item of a financial statement. So some clients might be approaching us to do audit of a single financial statement or even specific element of a financial statements. In that cases, how to do the engagements, that guidance has been provided by SA 805. That guidance has been provided by what? SA 805. Then we have third category. Sometimes the client might approach you and ask you to do something called audit of summary financial statements. Client might come to you and ask you to do audit of something called summary financial statements. Nothing but you might have heard somewhere. Now this concept is not there. There used to be something called abridged financial statements, where there will be complete set of financial statements will be there, balance sheet, P&L, breakup, notes, everything will be there. But in the old days, what used to happen is circulation used to happen physically by way of post and all. So when the circulation used to happen physically, annual reports used to be very bulky. When you add this MDA, notes to accounts, this all will be bulky. So it becomes very difficult to circulate the annual report. Even it used to become very difficult to circulate entire financial statements also, because notes to accounts itself will run for some 30-40 pages. So if you take the company like Reliance, circulating that full copy of the financial statements used to be very difficult, very costly affair also. Lakhs of shareholders are there. For all of them, you have to circulate. So in previous days, what they used to do is, there used to be one complete set of financial statements. From that, they will extract a summary. That means breakup and all will not be there. Just balance sheet, P&L, cash flow statement, some important 1 or 2 pages of notes. That's it. So that summarized financial statements they used to prepare, and this summarized financial statements will be circulated to the shareholder. But if at all shareholders want to view that complete financial statements, they will be made available for them. So whether this summary financial statements which is getting circulated, whether that is giving true and fair. Why? Because sometimes can do manipulation in that summaries also. Complete financial statements will give a true and fair picture, but when they're summarizing and circulating it, in that they can do a manipulation. There could be manipulations happening there as well. So that's why what they have told us, that summary financial statements are also required to be audited. In those cases, the clients will approach you asking you to do audit of summary financial statements. Then how you are supposed to do that audit of summary financial statements, that is explained under SA 810. That is explained under SA 810. So these 3 are the specialized areas, and these are the 3 standards. If we have discussed that 3 standards are specialized areas, where areas concept will be over. Okay, so what is the scope of this chapter? Number 1, SA 800, talking about how to conduct audit of the financial statements prepared as per special purpose framework. Number 2, which is talking about how to conduct audit of a single financial statements or a specific element or item of the financial statements. Then SA 810, talking about how to conduct audit of summary financial statements. If we are done with that 3, chapter will come to an end. Very easy standard. I am telling you, nothing new will be there. Only a few reporting requirements here and there will change. Since we are very solid in our foundational concepts in the standards on audit, this chapters we can complete like anything. Just only reporting part will be difficult. Only reporting thing, not difficult also. Reporting part we have to learn it in a new. Reporting requirements will change. Apart from that, everything will be same, and we have spent a lot of time. You will realize now what is the purpose of spending that much amount of time on 700, 200, all that series of standards. Okay, right. So first we will start with essay 800. How to conduct audit of financial statements prepared as per special purpose framework, or even you can say special purpose financial statements. Guys, do we know already what is the meaning of special purpose framework? Are we already aware of it? Yes. So what do you mean by special purpose framework? That framework which fulfills financial information needs of specific users of financial statements. So we need to check, we need to express our opinion whether the financial statements are, but if you are preparing the financial statements as per the requirements of some framework, but that financial statements will not fulfill the needs of everybody, that financial statements will fulfill the needs of only specific users of financial statements, that framework we are going to call it as special purpose framework. Now let us try to understand a few circumstances why this might be needed, a few examples where special purpose framework might be needed. Number one, in most of the cases, why we need the special purpose framework is when we go for loans, when we go for funding. So especially when you go for funding and all, the banks might ask you to prepare the financial statements not on accrual basis. They might ask you to prepare the financial statements on cash basis, or they will make some changes to accrual only, which they generally call it as modified accrual basis. So either they will ask you to follow completely on cash basis and prepare the financial statements, or what they will do is they will maintain accrual basis, but some items they will say these items you recognize only on cash basis. So that we call it as modified accrual basis. So that could be one case where banks or financial statements might ask you to prepare the financial statements on cash basis, because your actual loan repaying capability will not be determined by your book profits. Your actual loan repaying capability will be determined only by your cash profits. So that's why this could be the case where someone is asking you to prepare the financial statements completely on cash basis. Or there could be some other cases where you might be required to prepare financial statements on special purpose framework is, in some cases, law and regulations will tell you. In some cases, law and regulation, for some specific purposes, they might ask you to prepare the financial statements as per certain law and as per certain rules. If I have to give you one example, you take RERA. Builders are there. So for builders, this RERA Act will become applicable, no? So now RERA Act might say the builders to prepare the financial statements by classifying the cost and expenses per project, not the total expenses and all. They might ask you to prepare the project wise segregation of expenses. Like they might be doing some 3-4 projects, but they are required to segregate the expenses and show it in the financial statements as per the project wise. For each project, what is the expense? For each project, what is the revenue that they might have to say? So this could be one case where you might be required to prepare the financial statements only to fulfill the requirements of that regulatory authority. In our example, RERA. For RERA authority, they want to make sure that how much money you have collected for the sale of flats, what is the progress you have done when you are going to give the delivery. They want to know. RERA is a regulating authority for real estate. So to know that, RERA is asking you to prepare the financial statements as per project base. So that could be one example where here also financial statements are getting prepared only to fulfill the requirements of that regulatory authority. This also could be one example. Or one more case, one more example where the financial statements are special purpose financial statements is when you are required to get some grants, especially for NGOs. So NGOs need to get funds. NGOs, sometimes the government will give them grants, or some agencies will give them grants for fulfilling their NGO objectives. Say for example, one environmental protection NGO is there, which is working on greenery, which is working on increasing that greenery on the planet. So now that NGO needs funding. One agency came forward and told, okay, we will give you funding. But to give that funding, we want to know your operations, how much you have spent it on each project, what you have done. We want you to give the financial statements, then we will give you funding. But that financial statements, you don't prepare it as per the generally accepted accounting principles. We will give you some guidelines, follow that guidelines and prepare the financial statements, then we will give you the funding. Grant. So in these cases also, you might be required to prepare financial statements to fulfill the information needs of only specific users. So these are the examples of the circumstances where where an entity might be required to prepare financial statements only to fulfill the information needs of specific users. Clear everyone? So these are the examples. Now let us talk about audit related matters. How to do that audit. how to do that audit. Guys, everything I will try to infuse it in your brain, the standard, the technical terminology, all I will try to infuse it. Please follow the discussion. Okay. So whenever a client has approached you asking you to do the engagement for special purpose framework, financial statements prepared as per special purpose framework, first you have to decide whether you should accept that engagement or not. First you have to decide whether you should accept that engagement or not. Now what considerations you have to keep in mind before accepting the engagement? So first they say that the main consideration which you have to keep in mind, listen carefully, don't write. I will give you time to copy if at all required. I will not write anything that requires recording and all. So I will explain the concept only. I will give you structure for the concept. So if the client has come to you, asked you to do the audit of financial statements that to prepared as per special purpose framework, before accepting the engagement, you need to keep one important consideration in mind. What is that important consideration in mind is whatever framework that is getting used, whatever that special purpose framework that is getting used in the preparation of the financial statements, whether that framework is acceptable or not. Whatever financial reporting framework, whatever that special purpose framework which the management is using, whether that framework is acceptable or not. And how the auditor should take that decision, whether that framework is acceptable or not, how the auditor should take that decision is depending on what are the requirements of intended users. So there will be some intended users, no? Intended users means who? For whoever's purpose these financial statements you are preparing, whoever will base their decision on the basis of that special purpose financial statements, that people will call them as intended users. So depending upon the information requirements of that intended users, first we have to determine whether applicable financial reporting framework or whether that financial reporting standards, whatever the management has followed in the in preparing that special purpose framework, whether it is acceptable or not, we have to determine. So tell me, what is the number one consideration we need to consider before accepting the engagement? Whether financial reporting framework is acceptable, and the auditor should take this decision keeping in mind what are the requirements of the intended users. So the conclusion here is, if because of following that framework, if the information requirements of that intended users is getting met, then that framework is acceptable. If not, that is not acceptable. Right. And here they say that that financial reporting framework or that financial reporting standards might come from three places. That financial reporting framework according to which you are preparing the financial statements, that might come from three places. Might be that special purpose framework could have been given by some organization. Some standard setting organization has given that applicable financial reporting framework. Say for example, NGO is getting a funding. So in order to get the NGO funding, agency told you have to prepare the financial statements. And I asked the NGO asked how we have to prepare the financial statements. Now that agency told you prepare the financial statements as per some NGO accounting standards, which is given by one global organization. There is one global organization is there across the world. That global organization is having some NGO guidelines for the preparation of financial statements. So this agency told you prepare the financial statements as given by that organization, which is a global organization, reputed organization. They also have many members registered with them. They also take the assistance of the experts and all like us, and they have drafted that NGO standards. So you tell me, if the standards, if the financial reporting framework is given by that organization, which is global, which is transparent, which is taking the assistance of experts and all, in that cases generally we presume it as acceptable or not. If some organization, if some good organization has given the standard, will we presume it is acceptable or will you doubt it? We will presume it as acceptable. Generally we will consider it as acceptable. Sometimes applicable financial reporting framework which is getting used in the preparation of that special purpose financial statements might be given by some law and regulation or law or regulation. Like RERA example I have told. In the RERA Act itself, they have told how to prepare the financial statements. That means financial reporting framework itself is there in RERA. Then also will you deem it as acceptable or will you question it? Then also we will deem it as acceptable. And the last case, which is sometimes applicable financial reporting framework which is getting followed in the preparation of that special purpose financial statements might have been given under a contract. might have been given under a contract. Like for example, one startup entity is there. This startup entity made a pitch before venture capital. This venture capital firm told, okay, we will invest in your company. We will buy the stake in your company. But if we want to buy the stake in your company, you prepare us some financial statements and give it. Depending on that, we will determine how much stake you will get for how much percentage. But that venture capital has told in that contract only. In that contract only, they have told how to prepare that financial statements also. How to prepare that financial statements, they have told in the same contract whatever they have agreed. So now you have to follow the terms and conditions given in the contract for the purpose of preparation of special purpose financial statements. Now you tell me what is the source for that financial reporting framework in the given case? That specified contract. So in case if the financial reporting framework is given by the contract, we need to check whatever attributes generally we expect from a normal applicable financial reporting framework, whether all that attributes are also there in the contract. Or if I put it in very simple language, whatever characteristics which I generally expect in a normal applicable financial reporting framework, if those characteristics, if those attributes are there in the contract also, then I will feel it as acceptable. Like for example, in the general applicable financial reporting framework, what do we expect is it should be reliable. The financial statements should be understandable. It should fulfill the requirements of the users. That's what we accept from a normal general applicable financial reporting framework. If these characteristics are also there in the contract, like whatever terms and conditions, whatever rules they have given in the preparation of the financial statements in the contract, they are also understandable. If you follow that, financial statements will be understandable. They will be reliable also. It will fulfill the needs of the intended users also. Then also we will deem it as acceptable. So whatever it is, the first step before accepting the engagement of conducting audit as per special purpose financial statements is what? We need to check that financial reporting framework which is used in the preparation of special purpose financial statements, is it acceptable? If it is acceptable, well and good, we accept the engagement. If it is not acceptable, we will not. If it is not acceptable, we should not accept the engagement. And as a part of that extension, I have told that financial reporting framework, you might get it from three sources. One is from another organization, one is from some law and regulation, another is from the contract. If it is from other organization and law and regulation, we generally assume it as acceptable. If it is from a contract, we need to determine whatever attributes we expect from a applicable financial reporting framework, all that attributes are also there in contract or not. If it is there, we will consider it as acceptable. So whatever it is, evaluate that and accept the engagement. Okay, I have evaluated all the factors, then I have accepted the engagement. Now you have to plan and perform the audit. No, you have done only acceptance. You have accepted to do the audit of that special purpose framework. Now you have to start planning the audit. Now you have to start performing the audit. Now you have to start planning the audit. You have to start performing the audit. So what factors, what considerations you have to keep in mind while planning and performing such engagement? Very simple. We need to comply with ethical requirements. Even in the audit of special purpose financial statements also, we have to comply with all that 5 ethical requirements. Do you remember what are that 5 ethical requirements? Integrity, objectivity, confidentiality, professional competence and due care, professional behavior, independence, everything here also you have to comply. Number 2, you need to comply with all the standards wherever applicable. If some other, while doing this engagement, if some other standard is applicable, that standard also you have to comply with. Like for example, if you are conducting audit of special purpose financial statements, here also if some going concern related matters are there, SA 570 you have to follow. You are conducting audit of special purpose financial statements. In that financial statements, inventory is there. You want to obtain evidence regarding inventory, you have to comply with SA 501. So whatever standards which are applicable, whatever other relevant standards are there, all that relevant standards also you have to comply with. Yes or no? Next, you have to do the planning. SA 300 requirements you have to comply with. Then you have to determine your materiality. Here also you have to determine materiality. But one slight change here. What is the change here is, when we are doing audit of general purpose financial statements, we decide materiality keeping in mind the information needs of all the users. But while deciding materiality for the special purpose financial statements, we have to decide the materiality keeping in the information needs of only specific users. For the intended user, even small items also could be material. So that we have to sit with that specific user and we have to keep what are his information requirements. According to that, we have to determine the materiality levels. Then after that, we have to fulfill the reporting requirements under SA 260. Communication with those charged with governance. We have to communicate some matters with those charged with governance. All that communication matters you have to fulfill. And wherever suitable, you have to obtain written representations, SA 580 and all. So these are all the formalities. Generally, whatever we do in the audit, all that matters also we are supposed to do in the audit of the special purpose financial statements, like compliance with ethical requirements, complying with the standards, deciding materiality, doing the strategy planning and program, and communicating with the reporting requirement, communicating with those charged with governance. So all these things we will do. And finally, after we have performed the special purpose framework financial statements audit, even we are required to report also. Even we are required to give your reporting requirements. So here also we will give the audit report. That audit report is also required to be prepared as per the requirements of SA 700. Very simple, normal reporting requirements only. If the special purpose financial statements are prepared as per applicable financial reporting framework, that means as per the needs of that special purpose framework, they have prepared the financial statements, then we will give an unmodified opinion. If you have evidence that no, they followed something else than the requirements of the special purpose framework. See, here we will not comment on true and fair view. Here our objective is not true and fair view. Why? Because in special purpose financial statements, true and fair view could be there, could not be there. So when we are conducting audit of special purpose financial statements, what is our whole purpose of verification there? Checking whether financial statements are prepared as per special purpose framework or not. Whatever has been told in the special purpose framework, that has been complied with or not. That is our objective. If complied, we will give unmodified opinion. If not complied, we will give a modified. That could be either qualified, adverse, disclaimer, availability or non-availability of audit evidence, materiality and pervasiveness of the identified or possible effect of the misstatement. So same SA 700 requirements and all we will consider, and even we will give our audit reports also. But here they say one more extra thing when you are conducting audit of the special purpose financial statements. See guys, we all know that these special purpose financial statements are prepared only for intended users. And the information in that special purpose financial statements will help only this intended users. This special purpose financial statements and this audit report, this will fulfill the purpose of only that special users. This financial statements will be suitable only for the decision making of that intended users only. Now you tell me, other than intended user, if anybody has got this access to the financial statements and audit report, if he takes a decision on the basis of that special purpose financial statements, will his decisions be correct or will his decisions go wrong? His decisions will go wrong. Don't you think we have to highlight this information? Boss, these financial statements and this audit report is only for so and so intended user, so and so specific purpose. This is not for everybody. Don't rely on this. This we have done it only for the requirements of specific user for a specific purpose. You have to highlight this information in the auditor's report, and SA 800 says that you can use the emphasis of matter paragraph to highlight this information. What SA 800 has given the guidance? Use the emphasis of matter paragraph. See why? Because that is the only option we have. Other responsibility related matters, we will use it. Emphasis, generally we use it for to highlight any information which is already presented or disclosed. So we don't have any other option. So that's why what SA 800 told is, use in the emphasis of matter paragraph, highlight this information that this in financial statements are only for certain people, for certain purpose. This is not for everybody. And in addition to that, the standard also says, to the extent possible, restrict the distribution of this special purpose financial statements and audit report also. Don't just like normal financial statements upload on your website. Don't just like that circulate it. Do a limited distribution. What do you mean by limited distribution? Whoever is the intended user, to those people only you submit it. Don't unnecessarily update in your websites. Don't unnecessarily circulate it to everybody. So please be careful. Restrict the distribution and use of that special purpose financial statements and the audit report. That's all. Standard is over. That's it. So what we have seen, what is the meaning of special purpose financial statements we have seen, what considerations you have to keep in mind before accepting the engagement. Then we have seen what considerations you have to keep in mind when planning and performing the audit. Finally, reporting, restricting the use of the information and restricting the distribution. That's it. Let us read it. So SA 800, special considerations while conducting audit of financial statements prepared in accordance with special purpose frameworks. Let us see what do they say here. Special purpose framework. First, they are defining what is a special purpose framework. SA 800 defines a special purpose framework as a financial reporting framework designed to meet financial information needs of specific user. This we have already done it in our introduction chapter itself. Financial reporting framework may be a fair presentation framework, or it could be a compliance framework. Requirements of applicable financial reporting framework define form and content of financial statements and what constitutes a complete set of financial statements. So what should be the form, what should be the content, which items will form part of your complete financial statements, all that will depend on the requirements of applicable financial reporting framework. In this standard, financial statements refers to complete set of financial statements including related notes that contain summary of significant accounting policies. Even when I say special purpose financial statements, it refers to all items of the financial statements along with relevant notes. Now, what are the examples of special purpose framework? Like as you could see here, cash receipts and disbursements basis of accounting for cash flow information requested by creditors. Like for bank loan, you have to prepare the financial statements on cash basis. Or financial reporting provision set by a regulator to meet their requirements, like RERA. You can write RERA example here. Financial reporting provisions in contracts like bond agreements, loan agreements, or project grants. So that also could be a case of special purpose framework. Now, next heading, consideration when accepting such engagement. So what consideration you have to keep in mind? Acceptability of applicable financial reporting framework there. So in case of special purpose framework, financial information needs of intended users are a key factor in determining acceptability of financial reporting framework. So you have to, one of the most important consideration is you need to determine whether financial reporting framework is acceptable. And what is the main factor which you will consider in determining information needs of intended users? So depending on that factor, you will decide whether financial reporting framework is acceptable or not. And as I have told, financial reporting framework can be given by a organization, it can be given by a law or regulation, or it can also be given by a contract. Let us see what they say here. Applicable financial reporting framework may encompass financial reporting standards established by an organization that is authorized or recognized to promulgate standards for special purpose financial statements. That means in some cases you will get that financial reporting framework from one organization which is having the authority to release the standards. And in that case, these standards will be presumed acceptable. Generally, we'll go with the assumption that it is acceptable if that organization follows an established and transparent process involving deliberation and consideration of views of stakeholders. That means if such an organization which has given the financial reporting framework, if it is transparent, it is also taking the assistance of various experts in developing that standards, we generally presume it as acceptable. Then financial reporting framework prescribed by law or regulation. Some laws or regulations may prescribe financial reporting framework to be used by management in preparation of special purpose financial statements. Generally, as I have told, these are also acceptable. If you read the example, for example, a regulator may set financial reporting provisions to meet its requirement. In the absence of indications to the contrary, such a financial reporting framework is presumed acceptable. Then in some cases, what will happen is, whatever requirements laws and regulations are saying, and whatever requirements normal financial reporting requirements will have, if there is a conflict between the two. Then SA 210 says try to resolve that conflict. In some cases, if you are unable to resolve the conflict, don't accept the engagement only. If there is in extreme cases, unless it is required by law and regulation, you don't do such engagements if there is a conflict between what law and regulation is saying and what other generally accepted standards are saying. If there is an extreme conflict, try to resolve it. If you are unable to resolve it, don't accept it unless there is a mandatory requirement on you to do such engagements. So that's what they say here, where financial reporting standards referred to above are supplemented by legislative or regulatory requirements. SA 710 requires the auditor to determine whether there are any conflicts between financial reporting frameworks and additional requirement exist, and prescribe actions to be taken by the auditor if such conflict exists. So what you should do if such conflict exists? Either resolve it. If you are unable to resolve it, don't accept such engagements only. Next. Financial reporting framework prescribed by the contract. Applicable financial reporting framework may encompass financial reporting standards of a contract or sources other than those described in the preceding paragraphs. That means sometimes since organization will not give the standards, law and regulation will not give the standards, you will get that from other sources like contracts. And as I have told, in that case, acceptability of financial reporting framework in the circumstances of engagement is determined by considering whether framework exhibits attributes which are normally exhibited by a applicable financial reporting framework according to the requirements of SA 210. Then, in the case of a special purpose framework, the relative importance to particular engagement of each of the attributes normally exhibited by applicable financial reporting framework is a matter of professional judgment. That means I am asking you to check whatever attributes which are there in applicable financial reporting framework. If the same attributes are there in the contract, then we consider it as applicable financial reporting framework. No, sir, which attributes we expect in applicable financial reporting framework? That depends on the professional judgment. Like I told, reliability, understandability, I told you, this is not something which is stated. This is something which I, using my professional judgment, I have decided. So what are that attributes which must be there? That is something which you yourself have to decide on the basis of your professional judgment. Next. So these are the considerations when accepting the engagement. Now let us come to the considerations when you are planning and performing such audit. Number one, as you have told, SA 200 requires the auditor to comply with all relevant ethical requirements, including independence relating to the financial statements audit engagement, and even you have to comply with all standards on audit, unless that standard is not relevant for you. You need to comply with all the standards on audit while doing audit of special purpose financial statements, unless that standard is not relevant for you. If I have to give you one example, say for example, SA 600 is there. SA 600, when it will become applicable? Only when you are using the work of other auditor. Say for example, you are conducting audit of special purpose financial statements and you don't have any other auditors only. So that means their SA 600 is not having any relevance. Then you need not comply with the SA 600. So you need to comply with all those standards which are relevant for you. If some standard is not relevant or not applicable for you, those standards you can ignore. So whatever it is, you have to comply with all standards on audit, and also you have to comply with ethical requirements. And if you see, it requires auditor to comply with each requirement of a standard, unless in the circumstances entire SA is not relevant or requirement is conditional and the condition does not exist. If that standard is not relevant for you, don't follow it. If the standard will become applicable only when you fulfill some conditions, like for example, if you take SA 530, SA 530 will become applicable only when you have decided to go for sampling. If you don't go for sampling, SA 530 will not be applicable. So unless the standard is relevant for you, unless you did not comply with the conditions to become that standard relevant, try to comply with all other standards. Next. In exceptional standards, the auditor may decide to depart from relevant requirements in the standard by performing alternative audit procedures to achieve aim of that requirement. In such cases, you need to highlight that departure also. That's what they say here. Yeah, that only. Say for example, as per some standard, you are required to perform some procedure, but due to some reason, because of unavoidable circumstances, you are performing some alternative procedure. So you have to highlight why you have deviated from that requirement of the standard and which alternative procedure you have performed. Like for example, say SA 501, they are asking you to attend the inventory counting process. Because of some reason you did not attend the inventory counting process. Alternatively, you try to perform some procedures and get the evidence. You have to highlight it. So and so requirement I did not comply, because of what reasons you are unable to comply with it and what alternative audit procedures you have performed. Next. Application of some of the requirements of SS in an audit of special purpose financial statements may require special consideration. Some standards require special attention in special purpose financial statements. Like as I've already told you, materiality. Materiality needs a special attention. Why? Because in case of general purpose financial statements, we decide materiality based on the needs of various users. But in the special purpose financial statements, we have to decide materiality depending on the needs of intended users. Next. So that's what even they say in the example. Then SA 315 requires an auditor to obtain an understanding of entities selection and application of accounting policies. For financial statements prepared in accordance with the contract, auditor shall understand significant interpretations of the contract that management made in the preparation of those financial statements. An interpretation is significant when adoption of another reasonable interpretation would have produced a material difference. So now what they're saying is, when you are, as per SA 315, we need to understand about entity, environment and its internal control. As a part of that understanding, we will even try to obtain understanding of accounting policies followed. Now what they're saying is, in case if you are conducting audit of special purpose financial statements, if the framework is given by a contract, you need to even understand significant interpretations from the contract. So what do you mean by significant interpretation? When an interpretation will be considered significant is when adoption of another reasonable method would produce a material difference. Sir, what do you mean by this? Let me give you one example. Say for example, there is one research company. There is one research company. Now there is one pharmaceutical company. Pharma company is also there. Now this research company is doing some projects. What pharmaceutical company told us was, you do one thing, you do the research, whatever research cost you have incurred, we will reimburse it. Whatever research cost you have incurred, we will reimburse it. For that purpose, you need to give us quarterly financial statements according to some special rules and regulations. So pharma company told, you do the research and quarterly you submit your financial statements. How to prepare financial statements, we will give you the breakup. Whatever cost you have incurred on the expenditure, that we will try to give a refund, reimbursement we will give. So in order to get that reimbursement, this research company has to submit quarterly financial statements, that too as per the requirements given in the contract. So now, say for example, in the contract, they told that this pharma company will reimburse expenses relating to research. And in that they told that they will also give reimbursement of direct labor cost associated with the research. What did they mention in the contract? They will give a reimbursement of direct labor cost also. Whatever labor cost they are incurring for that research, that also they will give reimbursement. But they did not define clearly what will be included in the direct labor cost. Now here it needs an interpretation. Now there could be multiple options available. Say this research company is saying that when I say direct labor cost, it includes the salaries whatever I am paying. In addition to that, whatever health care, they will take insurance policies and all, no, health care, their staff operations, staff safety, the portion of that also will be included in the direct labor cost. Whereas another alternative interpretation also could be possible. What could be alternative interpretation? Might be tomorrow this pharma company could come and say, no, when I say direct labor cost, I am not talking about all this extra benefits. I am only talking about salaries and wages I have paid. So now this interpretation will become a significant interpretation. Why? Because there is an alternative assumption is available, but if alternative assumption goes, it is going to have a significant impact. Say for example, if you go by the research company's view, the total cost is coming to 10 lakh rupees. If you go by the pharmaceutical company's view, the cost is coming to 7 lakh rupees only. So it is creating a material impact or not. So you need to understand at the time when you are conducting audit of special purpose financial statements, when you are understanding an entity environment and its internal control, especially if the applicable financial reporting framework is given under contract, you read the contract, you need to understand that significant interpretations. Like this kind of significant interpretations, you have to pay attention. Able to understand everybody? So that's what they say here. Once again, if I read it, SA 315 requires the auditor to obtain an understanding of entities, selection and application of accounting policies. For financial statements prepared in accordance with the provisions of a contract, auditor shall understand significant interpretations of the contract that management made in the preparation of those financial statements. And when an interpretation is considered significant, when adoption of another reasonable interpretation would have produced a difference in the information presented. Next, in case of special purpose financial statements such as those prepared in accordance with the requirements of contract, management may agree with the intended users on a threshold below which misstatements identified during the audit will not be corrected. Sometimes they also will give instructions, no, you need not worry about the misstatements which are below 5,000. We don't want you to correct it. If at all you find it, then we will follow that. The existence of such a threshold does not relieve the auditor from the requirements to determine materiality. So management will set the limit, pay attention to that. In addition to that, you should also fix your responsibilities regarding materiality as per SA 320. Fulfill the requirements of SA 320 also. Then SA 260 requires the auditor to determine appropriate person within the entity's governance structure with whom to communicate. As per SA 260, you have to communicate with those charged with governance. So you have to identify who are the people in the organization who are falling under the those charged with governance definition. And in some cases, management and those charged with governance, both the roles will be played by same people. Then our reporting requirements will change or not? Yes. I told you in SA 260, right? When all the people who are involved in the management are also involved in those charged with governance, then you need not do double reporting. If you communicate with one party, the other requirements also will be fulfilled. That they say in the next point. SA 260 notes that in some cases, all of those charged with governance are involved in managing the entity, and application of communication requirements has to be modified. If both are playing the same role, then make changes to your communication requirements. And also one more thing they say, when complete set of general purpose financial statements is also prepared by the entity, those persons who are responsible for oversight of preparation of financial statements or special purpose financial statements may not be same as those charged with governance responsible for oversight of preparation of general purpose financial statements. Sir, what do they say here? So what are they trying to say here is, say for example, there is one company X Limited. This is a listed company. They will also prepare general purpose financial statements, like they will prepare financial statements as per Schedule 3 accounting standards. They will upload it on their websites and all. Now for the purpose of loan, they have also prepared the special purpose financial statements. They are having both. They are having general purpose financial statements also. They are having special purpose financial statements also. In some cases, what will happen is, the people who are having an oversight over general purpose financial statements may be different from the people who are having oversight over special purpose financial statements. Like if you take the pharmaceutical company, the previous research company example, whatever I have told, that company is preparing general purpose financial statements. That responsibility was given to CFO. CFO is monitoring the financial statements of general purpose financial statements. Then he will become the relevant person with whom to communicate. But when it comes to this quarterly financial statements for getting that reimbursement for pharmaceutical company, this responsibility of financial statements was assigned to research head. There is a research head in the company. To that research head, this responsibility was assigned. This research head is looking after the preparation of special purpose financial statements. Now for the purpose of SA 260, in the case of special purpose financial statements, who will be that those charged with governance? Research head will be that those charged with governance. So we need to be very careful. The people who are considered as those charged with governance for general purpose financial statements may be different from the people who are considered as those charged with governance for special purpose financial statements. Accordingly, you have to fulfill your requirements under SA 260. Then finally, after you have taken all the above into consideration, you have to form an opinion and you have to report. And how do you report that? By following the requirements of SA 700. Then description of applicable financial reporting framework. So regarding applicable financial reporting framework in audit reporting, they are telling some points. Like SA 700 requires the auditor to evaluate whether financial statements adequately refer to applicable financial reporting framework. So as per SA 700, you need to see that in the financial statements, management is clearly explaining their applicable financial reporting framework. Same thing you need to check for special purpose financial statements also. You need to check in the special purpose financial statements whether management is clearly explaining in the notes to account what framework they are following, why they are following it, for whose purpose they are following it. These disclosures must be given by management, where in the special purpose financial statements. So that's what they say. In the case of financial statement prepared as per the provisions of the contract, auditor shall evaluate whether financial statements adequately disclose any significant interpretations of the contract on which financial statements are based. I have already told you what is a significant interpretation. So management clearly should explain in their notes to accounts all the significant interpretations, all the applicable financial reporting frameworks. SA 700 deals with the form and content of the auditor's report, including specific ordering of certain elements. How to prepare the audit report and all. When it comes to this matter, we follow SA 700 strictly. Title, addressee, all that we will follow. In case of auditor's report on special purpose financial statements, when it comes to report, some special points they are trying to say. The auditor's report shall also describe the purpose for which financial statements are prepared, and if necessary, intended users, or refer to a note in special purpose financial statements that contain that information. In your audit report, if you feel it necessary, in the case of special purpose financial statements, you can say that financial statements are prepared as per special purpose framework, who are its intended users, or even you can give a reference to a note number. In case if all that information is given by the management in the financial statements in some note, even you can give a reference to the note. So generally we say this in the opinion paragraph. In the opinion we have two sub paragraphs. No, first paragraph we will say financial statements, identify the financial statement, and also we will say that give a reference to the notes, identify the components of the financial statements. 5 items will be there. No. So in that opinion paragraph itself, you can say that these are the financial statements not prepared as per applicable financial reporting framework. These are prepared as per special purpose framework for so and so users, that you can mention in the opinion paragraph only. Then, if management has a choice of financial reporting frameworks in preparation of such financial statements, explanation of management responsibility for financial statements shall also make reference to its responsibility. That means, say for example, management is required to prepare special purpose financial statements as per some contract. Now in the contract itself, the person, the intended user, whoever is there, in the contract itself, he has given two options to choose. Like for example, he asked you to prepare the financial statements either on complete cash basis or modified accrual basis. He has given two options. He told we don't want on accrual basis. Either you follow complete cash basis or you follow modified accrual basis. Here option has been given to whom? Management. So management has to choose one among the two. If such case is there, then in that case, you will give the management responsibility paragraph, no? There you have to add this line. So in the management responsibility paragraph, you have to say that here management has been given two options and the management has chosen so and so option. So that line you have to add. In which paragraph? Management responsibility paragraph. We'll give management responsibility, no? In that paragraph, you have to add this line. So that's what they say here. If the management has a choice of financial reporting frameworks in preparation of such financial statements, explanation of management's responsibility for such financial statements shall also make a reference to its responsibility for determining that applicable financial reporting framework is acceptable. They have given two options. You have chosen one. Why you have decided that is acceptable? So that also you have to add it in the management responsibility paragraph. And in case if you are communicating key audit matters in your audit report, you have to communicate, you have to comply with the requirements of SA 701. And even SA 720 also will become applicable. Just now as we have discussed, if these special purpose financial statements are getting given with other information, we need to check consistency. If inconsistency is there, what action we have to take as per SA 720. So all that requirements here also will become applicable just now as we have completed. So that is why I have first explained SA 720. Why? Because this reference will be there in every standard we are going to see now. In 800 also they will give reference. In 805 also they will give reference. In 810 also they will give reference. So if you read it here, SA 720 deals with auditors' responsibilities relating to other information. In the context of this essay, reports containing or accompanying special purpose financial statements, the purpose of which is to provide owners, will be deemed to be annual reports. That means if these special purpose financial statements are containing some other information, that other information we generally deem it as annual report. For normal audit, annual report name will be there. But in case of special purpose financial statements, if this information is getting included with some extra information, that we generally consider it as annual report, and our responsibilities whatever we have in SA 720 when it comes to annual report, all that responsibilities will be there here also. Next. In case financial statements are using special purpose framework, the term similar stakeholders include specific users. That means when you are giving other information in normal audit, in normal financial statements, they include other information for their stakeholders, no? In special purpose financial statements, they include other information for the purpose of intended users. Next, when auditor determines that entity plans to issue such a report, requirements of SA 720 also will become applicable. So these are some few special points regarding applicable financial reporting framework description in the auditor's report. So what they have told here, if I have to give you a summary. So first, management should disclose in the applicable financial statements what is their applicable financial reporting framework. And also management should disclose significant interpretations from the contract. When you are preparing the audit report, you follow the requirements of SA 700. Then you should describe, the auditor's report shall describe that this is not general purpose framework, this is a special purpose framework, who is intended user, and also give a reference to the note. So either if you want to say it in the opinion paragraph, or even alternative option, you can do it in the emphasis of matter. Why? Because as I have told, alerting the readers, so that you can use emphasis of matter also. Then if management has a choice between two options, they can choose one, and that has to be added in which paragraph? Management responsibility paragraph. In case if you want to communicate key audit matters, comply with SA 701. If these special purpose financial statements are getting published with other information, SA 720 requirements also you have to comply. Clear? Next. As I have told, alerting the readers that financial statements are prepared in accordance with special purpose framework. So as I have told, special purpose financial statements may be used for purposes other than those for which they are intended. It might be relied on different people for different decisions. So that's why, to avoid the misunderstanding, auditor alerts users of auditor's report by including an emphasis of matter paragraph that explains that financial statements are prepared as per special purpose framework and they are not suitable for any other purpose. SA 706 requires this paragraph to be included in a separate section of the auditor's report with an heading emphasis of matter paragraph. Even an extract of presentation has also been given here, like as you could see. We draw your attention to note number so and so to financial statements which describes basis for accounting. The financial statements are prepared to assist company in complying with financial reporting provisions of a contract, not for everybody. As a result, financial statements may not be suitable for another purpose. Our report is intended solely for the company and DEF Company Private Limited and should not be distributed to other parties. Our opinion is not modified. So like this, you have to add one emphasis of matter paragraph, alerting the users that it is only for special purpose for intended users. Next, as I have told, in addition to all that, you have to even restrict its distribution and use. In addition to alert required as discussed above, auditor may consider it appropriate to indicate that auditor's report is intended solely for specific purposes. Depending on the law and regulation, this may be achieved by restricting distribution or use of the auditor's report. I will give strict management regulations. Sir, don't circulate it. Give it only to your intended users. This should not come out. And also I will take the help of law and regulation. What the law and regulation says, if they have any stringent provisions, that also I will take into action to make sure that this report is not going to other than intended user. In these circumstances, paragraph alerting readers may be expanded to include these other matters and heading modified accordingly. So in case if you are restricting strictly, that line also you add it. We are restricting this use. If you find this at any other place, it will be a violation. So like that, you can even extend that emphasis of matter paragraph if you are restricting the usage. That's all. This is what regarding SA 800. Simple standard, nothing we have learned new. Just we have understood what is special purpose framework, what considerations you have to keep in mind before accepting. That is the only new thing which we have learned practically. Apart from that, nothing else is there. Everything we already know it. So just go through the standard ones quickly. Don't talk. I will make you answer the questions if you talk. Okay, so we'll have a look at the questions now. Very simple questions only we have here. Dear Lalita is an auditor of company. She is also offered professional work of audit of financial statements prepared specifically for meeting requirements of a loan agreement for the same period. She chooses to accept the work and has made up her mind to disclose this fact in emphasis of matter paragraph in audit report to be issued by her for this specific engagement. Is her approach proper? Yes. So she is conducting audit. She has been approached and was asked by the company saying that, sir, we have prepared the financial statements as per the reporting requirements of a loan. So for that purpose, they have prepared the special purpose financial statements. Auditor accepted, and she chose to accept the work, and she wants to disclose that fact in the emphasis of matter paragraph. Is that proper? Yes, that's what even we have seen in the reporting requirements also. Next. CA Lakshmi has prepared a draft audit report for financial statements of X Limited, prepared in accordance with the financial reporting provisions of a contract with Y Limited. She has drafted an unmodified opinion to be given in audit report. Besides, she has also drawn attention in draft audit report to note A to the financial statements, which describes the basis of accounting under the heading basis for accounting. How she should ensure that report would not be misused. Draft a suitable paragraph to be included in the report for the same. Alerting the readers. We have seen that paragraph. No, you will use an emphasis of matter paragraph, give a relevance note. There you say that this financial statements are only for intended users, for specific users, for specific purpose. They should not be for everybody. This highlighting where we will do. Generally, emphasis of matter paragraph we will do. So she may consider it appropriate to indicate that auditor's report is intended solely for specific users. Depending on the law and regulation applicable, this may be achieved by restricting the distribution. In these circumstances, the paragraph alerting the readers may be expanded to include these other matters and headed modified accordingly. Heading modified accordingly. So the para will look like basis of accounting and restriction on distribution and use. So like they are referring to that last line, whatever we have read here. So if you see what they are telling, if you want to restrict the use or distribution, so what they have told, you can, in these circumstances, paragraph alerting the readers may be expanded to include those matters, and even they are asking us to modify the heading, no, if required. If you are restricting the use, even in addition to highlighting that, if at all you want, you can even modify that paragraph. So what you can do is, if you want to restrict the use, instead of highlighting that paragraph, instead of using the heading of the paragraph as emphasis of matter paragraph, you can also use this paragraph. This is one illustration for that. How can you modify the heading? So how he has modified the heading? Basis of accounting and restriction on distribution and use. So instead of using emphasis of matter paragraph, he has modified the heading altogether. So without modifying our opinion, we draw attention to note number A to the financial statements which describe basis for accounting. The financial statements are prepared to assist the company to comply with financial reporting provisions of the contract as referred to above. As a result, the financial statements may not be suitable for another purpose. Our report is intended solely for X Limited, and this report should not be distributed or used by parties. So that relevant paragraph has been expanded and even heading is also modified. Next. SA 800 deals with special considerations applicable in respect of audit of financial statements prepared in accordance with special purpose framework. Explain by giving examples the meaning of special purpose framework. So they're asking you to give the meaning of the special purpose framework, and also they're asking you to write examples. We have already done it. The first part of the SA 800 deals about that only. Next. I think that's it. So many questions we have from SA 810. That is where some reporting complications will come. Apart from that, yeah, rest of all the things are relating to SA 805 and 810. So now what we should do, I am in a confusion now. So it will take some time. If I start SA 805, it will take little time. It will take around 1 hour. Should I give the lunch break now? Huh? Don't want? So I will give the lunch break. Yeah, we'll give the lunch break. But the thing is, lunch break will be little bigger. So I will come back by 2:30. Okay. So today you have 1.5 hour of break, but I will compensate after the break. 2 hours only. See, 2:30 I will start. 4:30 I will leave. The remaining 2 standards will not take much of a time. So since we, as I have told you, this standard also we did not discuss much. Everything is basics only, right? The same thing will get repeated in the next 2 standards also. So little bit than usual, some half an hour extra I will take, and I will complete 805, 810 both. This specialized areas we will wind it up today. Okay, right.